Josh Hawley's statement on this and do anything differently one way or another. The Warren thing, too, I think mostly is relevant in terms of shedding light on a pre-existing shared perspective rather than as a sort of exogenous source of pressure on the antitrust enforcers. Like, I don't think that they're taking marching orders in real time from Warren, but do, broadly share her kind of analytical perspective on this. So, it's a useful incremental signal about what they're going to do because they have such shared DNA, more so than because they're kind of directly responsive to the political imperatives that are being laid out by Warren, Brown, Hawley, and others of that kind.
There's a potential government shutdown next week. So I want to get your take on how you see this playing out, given the fact that we do have lawmakers in recess. Do you think there could be a shutdown, given when they come back, they have 2 to 3 days to hammer out appropriation bills to make sure the government is funded?
Yeah. It's certainly a possibility. I think the likelihood that they actually get a bipartisan deal on an appropriations package in place in advance of the March 1st deadline seems quite low to me. They're theoretically making progress, but progress is always slower when they're negotiating while Congress is on recess. And by all accounts, there are a lot of sticking points remaining. So the question is more about, are we going to get another short-term continuing resolution? I think the two possibilities are either we get a CR, or I would not be that surprised to see a short-term shutdown of the 4 agencies for which appropriations lapse on March 1st, in this sort of period between the March 1st and March 8th, laddered deadlines. I don't think that there's much willingness to let defense appropriations in particular lapse. But Speaker Johnson, I think, has shown he really does not want to shut down. He promised he was never going to do another short-term CR in advance of the last shutdown deadline. And of course, he ended up doing so. So, push is coming to shove right now on whether or not we get a CR or a lapse in funding. And I think he's made quite clear that his political and substantive judgment is it does not really make any sense to plow into a shutdown that nobody wants. So my operating assumption is that they'll get another CR in place, despite the, sort of moaning and wailing that we get from the right wing on that. But that remains to be seen. Johnson's decision-making has been somewhat hard to predict more than a couple days out.
Tobin, you said that nobody wants a shutdown. Is that true? Does the former president want a shutdown?
Yeah, that's fair, I guess. Neither party's congressional leadership wants a shutdown. And, there are some voices. I don't think that even Trump really sees clear political advantage from this. He and the policy writers at stake are not really the kinds of things, like the things that would be triggers for a shutdown are not really that near and dear to Trump's heart. Like, he weighed in, obviously, on the immigration and Ukraine deal. That is something that is kind of core to this case he wants to make to voters this year. I don't really think that anything that's at stake in the current appropriations negotiations have that character. So, at some level, he probably has a generic interest in kind of chaos and dysfunction under Biden, but I don't think this is the thing that he's, sort of most mobilizing his persuasion efforts vis-a-vis House Republicans on.
It seems like for the large point of view, we're really moving on from the Alexei Navalny issues and the fact that he was killed or died by unspecified causes in a penal colony in Siberia in Russia. There's a question about whether this was going to actually cause people to have more urgency to pass aid to Ukraine. Have you seen that been borne out in any way ahead of the announced potential sanctions from President Biden tomorrow?
Yeah, I don't think that the Navalny developments really changed the congressional calculations. Even on the sanctions front, what I have heard is that this is largely a sanctions package that has been under development for the second anniversary of the war that's been kind of accelerated and rebranded around the Navalny thing. It's not as if, this is the first conduct from Russia that we have seen fit to punish. I think for the most part, we've already sanctioned everything that we think it makes sense to sanction. So this is not going to be I don't want to say symbolic, but it's not going to be a completely earth-shattering set of sanctions. From a congressional perspective, I continue to think that the way that aid for Ukraine either does or doesn't get done is based on, sort of backroom, four corners negotiations between Johnson and the House and Senate Democratic and Republican leadership. I think he's quite genuinely cross-pressured on this. I think his political incentives not to allow a vote on Ukraine aid are quite strong, but he has done the quote-unquote responsible thing in some surprising situations before, with the FISA surveillance extension issue being one case in point. There was sort of an obvious path for him to behave as a movement conservative, to take Jim Jordan's sort of version of that bill and put it on the floor And that's not what he did. He's sort of gone along with what the Washington security establishment, would have hoped for from him. And so I think it's possible at the end of the day that he just says, you know what, the political cost is going to be real to me from the conservative side, but I'm going to go ahead and allow this to be attached to the funding bills because it's the right thing to do in the face of pressure from the Senate and the White House. But again, I think he's really going kind of day by day and hour by hour. So it's hard to have terrible degree of confidence about what Johnson's going to do.
Hey, Tobin, we've got to go. It's good to hear from you. Tobin Marcus there of Wolf Research on the latest down in Washington and the fact no one seems to like companies buying other companies. We'll talk about that later. I need to check in on the health of NVIDIA. The stock is up by 14.5%, Lisa, in the pre-market.
Which really means that it's going to be something like $240 billion of market cap added in one day.
Which is a new record, right?
Potentially. This is the question, right? How do you price in astronomical growth that's not ending? I have no idea. Other people are trying to, and evidently it's up.
What multiple do you put on those kind of numbers we went through? It's like mind-boggling.
I mean, given the fact that there's, 400+% growth in a year in some of the revenue streams, how do you multiply that?
I checked the analyst recommendations last night to see, is anyone even saying sell this stock, don't hold it or buy it? Last night, one analyst. This morning, that individual has changed his setting to hold, no longer a sell. How do you see results like that and forecasts like that and think, no, actually, you should sell this?
Yeah, I think we call that career risk. When you see moves like this one and you've got to sell on the stock, I think we call that career risk. This stock is up by more than 14%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Good morning, John. More on NVIDIA. NVIDIA shares up in pre-market trading after the AI darling delivered another eye-popping earnings report. The world's most valuable chip maker says revenue in the current period will come in at a better-than-expected $24 billion. CEO Jensen Huang says demand for NVIDIA's newest products will continue to outstrip supply for the rest of the year. NVIDIA's market cap has increased by more than $400 billion this year, bringing its valuation to $1.7 trillion. Mercedes shares trading higher in Germany. The automaker's gloomy forecast offset by an announcement of a $3.2 billion share buyback program. The CEO warning that its electric vehicles will remain more expensive than their combustion engine siblings for years to come as it braces for cooling demand for cars with a plug. And Apple is rolling out a free iPhone app to deliver real-time scores, stats, and more to sports fans. The app is called Apple Sports, and it's available for download in the United States, the UK, and Canada. It will include stats from the major leagues, including the NBA, MLS, and college basketball. Apple says it plans to add more leagues over time. That's your Bloomberg Brief. John.
Shonali, thank you. I just struggle to believe that's a real story. Like they're finally caught up and they're offering sports scores on a mobile phone.
Isn't that the ESPN app?
I mean,
I just don't get it. Live score, take your pick.
it raises this, they've been so behind on certain very specific things. Does this mean they're going to sort of tiptoe into it and suddenly do sports bundling and compete with the tie-up?
I've got not much to say about that at all. Just ridiculous. Up next on this program, the Fed weighing the risk of cutting too soon.
Since that meeting, we in the Fed have gotten the CPI inflation data, which came in very hot, and a gangbusters employment report.
That's next on the program, live from New York. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
What's happening on Wall Street?
There are so many factors that play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
We are looking for a cool $200 billion market cap move at the open on a single name, NVIDIA. That name is up by 14% in the pre-market, a beat on earnings and a beat on the outlook as well. In the equity market more broadly, up by 1.36% on the S&P 500, the Nasdaq absolutely flying. In the bond market, yields lower by a single basis point, 430.29. Hardly even talking about the Federal Reserve. Under surveillance this morning, the Fed weighing the risk of cutting too soon.
Since that meeting, we in the Fed have gotten the CPI inflation data, which came in very hot, and a gangbusters employment report. So as is often is the case, these are a little bit stale. But my bottom line is maybe a touch more hawkish than perhaps we got out of the chair's press conference in January.
Here's the latest this morning. Minutes from the Fed's January meeting showing members were united in delaying rate cuts. Only a couple of officials pointed to risk to the economy from waiting too long. We'll get another peek into the Fed's thinking today. Jefferson, Waller, Cook, Harker and Kashkari all set to speak. Sarah Huner, Standard Chartered, joins us now for more. Sarah, let's get into the Fed. Does that sound like an FOMC set to cut anytime soon?
It certainly doesn't. I think that we're looking at the earliest at the next quarter. Our own view is June. I think markets are broadly in line with that. Of course, we have to see what happens with the upcoming inflation data, the upcoming employment data. We have a sense that the next core PCE reading is going to be strong after about 3 months of pretty subdued inflation reports on the PCE front. Of course, the all-important February employment report, does it show January just to have been a surge in new hires at the start of the new year? Does it show January to have been a boost in wage earnings growth, again, a new year phenomenon, or is it something which is likely to persist in the coming months?
Sarah, I've been kind of nasty. I've been a little bit mean about the euro-dollar cross and how it's not very interesting because it's the same story that we know on both sides and it isn't changing, and then people basically emphasize different things each day to come up with incremental moves. Am I wrong, or is this basically how it feels to you too?
I think so far it has done, but I think what is interesting about Eurodollar is that we've had a lot of very positive news on the US front. It hasn't done a huge amount to help the dollar recently. We've had some very negative sentiment around the euro area, and yet today's PMIs suggest that it's not all one way for the euro area, so that there's some glints of positivity there. So it does feel as if there's potential for euro to do better over the coming weeks and months as we get perhaps a realignment of expectations, perhaps better expectations, or at least not such bad expectations on the euro area front, and potentially sort of fading enthusiasm on the US front.
Well, do we get the sense that the AI boom is isolated to the United States, or the benefits are trickling elsewhere that people haven't kind of realized yet, and that story has legs beyond NVIDIA?
That story definitely has legs, but it's very much a structural story, and I think it's difficult for markets to incorporate that into the sort of day-to-day. What does it mean for, activity data in Europe? What does it mean for policy in Europe? So it's an important, absolutely fundamentally important aspect of economic activity and economic growth over the coming years. But in terms of this sort of day-to-day market moves, there seems to be more of an influence on the US than elsewhere.
When I look at Germany this morning, manufacturing downturn unexpectedly deepened in February. At the same time, you have Mercedes-Benz, massive German manufacturer, buying back shares. How does the ECB look at all of this ahead of their rate decision?
Manufacturing is important, and clearly it's very important for the German economy, but overall for the euro area, I suspect that ECB is looking more closely at what's happening to services, what's happening to activity in the services sector. What does that mean for employment, which is still at close to full employment, and how does that then feed through into wages? We know that they're waiting for further evidence that wage growth is decelerating. We had some indications of that already in the fourth quarter, but ahead of their meeting in April and in June, they'll want to see further clear evidence that there's going to be no upward pressure from wage growth feeding through to inflation and sort of disrupting that steady downtrend that we see in inflation towards the 2% target.
Sarah, with that in mind, could you explain for our audience just how important the upcoming wage negotiations will be in certain countries, including in Germany, going into the middle of this year?
Yeah, super important in terms of what information that gives to policymakers. The wage data that we have here in Europe, in the euro area in particular, is not so timely as we get in the US, and therefore it's very much a matter of what the current wage rounds show, how do individuals feel about the prospects for inflation. There's some slightly sort of worrying uptrends in inflation expectations in the euro area, and policymakers will want to be clear that wage growth is not echoing that, those expectations.
Sarah, the Fed has offered a threshold to reduce interest rates. Basically, Chairman Powell said in the last news conference at the end of January, we just need more good data. Not better data, just more good data, and maybe not even as good. Sarah, what's the ECB said about what the threshold is to reduce interest rates?
Well, it's inflation, and inflation on the medium-term horizon, if we want to be technical about it. So it's clear that for the ECB, the softness in economic activity is not a reason for cutting interest rates. It could be a factor behind future slowdown in the employment story, and that in turn could dampen wage growth. But it's all about inflation and what are the drivers of inflation from the ECB's point of view. And it's these domestic drivers. We're still seeing low goods inflation, disinflation on the food front, but services inflation is still too high. It's 4%, and that's not consistent with getting overall inflation down to 2%.
Hey, Sarah, great to catch up. Sarah Hewitt there of Standard Chartered on the difference between the ECB and the Federal Reserve. Some might argue the Federal Reserve has been a little more clearer about the threshold to reduce interest rates. The Federal Reserve, in their minutes, Bramo, I have to say, you can call them stale, you can say they're carefully crafted. I think what it speaks to overall, this Federal Reserve is not in a rush to reduce interest rates anytime soon.
This line in particular caught people's attention. Some officials noted the risk that progress towards price stability could stall, particularly if aggregate demand strengthened or that progress in improving supply chains could falter. This is a new kind of tone, fear of an upside risk to inflation that really wasn't present in the previous press conference.
Biggest risk right now, cutting too soon or waiting too long?
Well, 2 weeks ago, it was waiting too long, and now it's cutting too soon. So that sort of this subtle shift under the hood on the margins has cost a 60 basis point increase in 10-year yields since the end of December.
Isn't it funny? Everyone says one data point doesn't matter, but then one data point really changes the conversation. And that one data point last week was CPI, and then you can make it two with PPI.
Which is the reason why I think people are leaning into this idea that maybe they have more ability to be patient. Now we're just pricing in a 30% chance of a May rate cut. So this is how far people are pushing back. We did see TD Securities actually ratchet back their expectations for rate cuts to only 5 this year from 8.
Just 5.
So yeah, this is clearly shifting people's understanding of what the tail risks are.
Marko Klanovic of JP Morgan mentioned him a few times this morning. The 25% stock market rally since October was predicated on a repricing of the Fed from cutting only twice in 24 to cutting something like 7 times based on January pricing. While most of those incremental cuts are now priced out, the stock market did not correct at all. That remains a mystery for people like Marko.
And then you get NVIDIA, and mystery no more. Because at the end of the day, like Ben Gutteridge said, with not blowing trumpets and not too enthusiastic, basically it's all about the earnings.
NVIDIA right now up by 14% in the pre-market. Coming up next, Luke Cower of UBS Asset Management, Hope Domchowski, CFO of First Horizon, Stefan Bansal, the CEO of Moderna, and Kathy Jones of Charles Schwab. The second hour of Bloomberg Surveillance up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything. Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television. People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Not really sure when the Fed goes the first time. Is it June? Is it July? For most of your viewers, it simply doesn't matter.
The Fed is steady as she goes in many ways, and it's creating, I think, a lot of volatility.
I think inflation is stickier than maybe some folks would have thought.
The lumpiness in inflation is just part and parcel of going through what we're going through, a normalization of interest rates.
A lot of the inflation data that we saw recently was largely seasonal, and that will reverse in the next couple of months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Never mind the S&P 499. Let's talk about the S&P 1. Live from New York City this morning, Good morning, good morning. Equity futures are positive by more than 1% on the S&P 500. Nvidia is higher by 14%. Bramo, we talked about it yesterday. Here it is, lighting up this market.
Which would be equal to about $238 billion of market capitalization added in a single day. You noted that that was more than the one-day record gain that we saw in Meta, greater than another Disney added to its market valuation.
3 weeks ago.
3 weeks ago. This is a new era. How do you frame out a seismic shift in technology that seems to be being adapted at a record pace?
We've talked about the reaction from the South side. Bloomberg Intelligence validates AI demand momentum, vital knowledge, the report, the outlook, quote, great. Wedbush, Dan Ives, game changer, was with us an hour ago. He said it was 1995. Let's sit on that. Why isn't it 1999 when you see moves like the one we saw on Meta at the start of the month and on Nvidia this morning?
Because their profits, their revenues gained more than 400% year over year. That is different than 1999, where someone put up a shell company, had a .com after the name, and raised $1 billion. So this is sort of the difference right now when you have companies where people can't get enough of their actual products that seem to be delivering something that a lot of people want.
Revenue more than tripled. It's real. It's not fictional. It's amazing. It's just incredible. And what's incredible here, Anne-Marie, it could have been so much better if we didn't have those problems in China.
This is what Bloomberg Intelligence took out of the report, the fact that revenue was 22.2% a quarter earlier, and it halved in the fourth quarter, 8.8% in China specifically. So how much bigger could profit and revenue have been if they were able to actually go after the biggest market in semiconductors, and that's China, and obviously they're being held back by export controls, which they said, of course, they're going to make sure they're in line with U.S. law.
I need to do a deep dive on the actual construction of these things. I'm very curious about it because I want to see what the barrier to entry is. And when you have technology that's moving so quickly, it's unclear what the next iteration of this is going to look like. That's the big risk, is that suddenly these things become obsolete. Is it going to take 5 years, 10 years? Is it going to take 2? But we talk about the railroads. We talk about the car and Ford at the time when that was a new product. Is this transformative technology seeing only a 2-year day in the sun, or is it going to be 5 years, or is it going to be 15?
So how important is Fed policy, given what's taking place right now? Do we need to de-emphasize that, given what's taking place with this single name driving these massive gains in this equity market, not just stateside, but arguably worldwide? Let's go back to that quote from Marko Klanovic over at JP Morgan. The 25% stock market rally since October was predicated on a repricing of the Fed. While most of those incremental cuts are now priced out, the stock market did not correct at all. Does this single name explain why Marko is struggling with this market?
I would say yes. And it's not just this name, but AMD, and there are other names as well.
Meta too.
Meta as well. And then if you think, okay, healthcare companies are going to adapt to certain AI, generative AI types of productivity gains, they too can benefit and see maybe outsized type of expansion regardless of Fed policy. This is why it's so tricky. And this is why, frankly, a lot of people's eyes are glazing over when you start talking about Fed policy these days.
Nvidia right now, up 14%. Fed policy, eyes glazing over. Mini Fed meeting taking place today for those of you interested. Tons of Fed speakers, Harker, Jefferson, Cook, Kashkarian, and Waller. For those of you still interested in what the Fed's got to say, because at the moment there doesn't seem to be much interest at all. Nvidia's up 14%. The broader equity market's up 1.3% on the S&P 500. Bond yields, what are they? Bond yields look like this on a 10-year. We're down almost a basis point, 430.89. Coming up this hour, Luke Carr of UBS on Nvidia's blowout earnings report. Hope Dumchowski, First Horizon Bank CFO, on challenges facing the regional banks, and Stefan Bassal, the Moderna CEO, on the company's, quote, year of transition. We begin with our top story. It is Nvidia, flying in pre-market, trading as the AI boom shows no sign of slowing. The chipmaker's outlook blowing past estimates and driving the S&P 500 higher, much higher. The company CEO saying this: accelerated computing and generative AI have hit the tipping point. Demand is surging worldwide across companies, industries, and nations. Luke Carr of UBS joins us now to discuss. Luke, good to catch up. Overweight global equities, congratulations, you've turned to neutral, and stocks are still running. What are you thinking now?
Certainly makes you a little nervous whenever you see a blowout report like that from world's most important company. But no, our view has kind of been that a lot of the juice has been squeezed in terms of what we got in the 3 months ahead of going neutral. That was effectively a 97th percentile move in global stocks, the kind of move you'd only ever gotten historically in the past 30 years when we were emerging from a recession or during the heyday of the dot-com bubble. So, the parallels do kind of run there. Obviously, Brahmo's pointed out the differences in fundamentals to that point of view, but from our view, this is not really a bearish call in the economy. It's not really even a bearish call in the stock market. It's really more about squaring up and saying that, hey, after this big run, we just think the risk reward is a lot more neutral in terms of the positioning metrics in particular that we track. Those are the ones that inspired us and kept us in the market, even when we were kind of undergoing some wobbles last year in Q3, late Q4. And those now have turned a lot more, suggesting investors are a lot more engaged. Right now, that just means to us that there's a lot more susceptibility, a lot more vulnerability to any negative shock, whereas the right tail is a function, in our view, of a much more selective part of the market, and we can get exposure to that in other ways or directly.
There is this issue with valuation, and I saw that from Julian Emanuel as well, that typically in the past, when you have this type of valuation gain, you have less than a 1% increase on the S&P at best in the following year. Has history been interrupted by generative AI and a transformative technology that seems to have endless demand?
Well, you never kind of want to fight history too much, but however, that is part of that is part of the thesis, a big part of the thesis for not being underweight at this juncture. It's knowing that, hey, if we still have a positive view on the macro economy, if we still think that, and if anything, we think the left tail for the economy has come in over the past 1, 2, 3 months, not recession risk increasing at all. If we're still going to be a world in which the economy is growing, whether it's 1.5 to 2.5%, do we really think, like you said, Fed policy doesn't really matter to investors much? Does growth of 1.5 versus 2.5% really matter that much in a world where some of the world's leading companies are growing earnings that fast? However, no, it doesn't. So that is something in which it is a little different this time.
Hold on, just to set the record straight, Fed policy matters quite a bit, just maybe not for NVIDIA. It matters for a lot of the smaller companies that actually have been struggling and haven't seen the kind of growth to catch up with the NVIDIAs of the world. How do you sort of bet on a broadening out without a view on the Fed, or is the Fed instrumental there in terms of how many rate cuts they do is directly correlated to the strength in some of these smaller companies?
Well, I certainly think that the biggest beneficiaries that we had seen of the Fed pivot were names that effectively needed the cycle to extend, and the Fed was viewed as effectively raising the risk of the cycle not being able to extend because of lagged effects of monetary tightening or what have you. But what happens as growth continues to stay strong, even as the Fed even pushes back the timing of rate cuts, that perhaps opens out a bit of a window for broadening out. However, that is a bet we've largely closed in terms of that sense. On the one hand, you do have, I think, some supportive signs from global PMIs starting to pick up, but that's probably more of a measured rebound and has a lot more to do with inventory rebuilding than any kind of genuine thrust to growth that's quite important. And on the other hand, you do have the pushing back of Fed expectations. Do find that quite important, and we do find that earnings growth is becoming more concentrated. We like to follow earnings growth. We know that even at rich valuations, it is going to be earnings growth that is going to drive the market. But the valuation does affect that forward risk-reward proposition, which is kind of how we end up in this more neutral position.
Luke, I was looking at your most recent report. You're looking for faith in a soft landing to be slightly shaken. What do you think is going to shake it up?
I think it will be more slightly shaken than anything, not in terms of the downside risks to the economy, but more kind of what we've seen on the inflation front recently to start the year. So when we're kind of dividing into different economic scenarios and probability weighting, where yields, stocks, et cetera, are going to be in each one, for us, the economy and the rates market has more and more priced a kind of persistent inflation environment. And if you try to decompose the Fed's inflation forecast, how do you get from where we were, the 3.2 Q4 to 2.4 at the end of this year? How do you get there? What does that sequentially look like? In our view, that really looks like almost what we've gotten so far. It involves and it implies 3-month annualized inflation on core PCE picking up closer to 3%. It involves 6-month rising closer to 2.5% in the months to come. So a Fed that's looking for greater confidence even as, I would argue these readings are probably very much in line with their internal forecast on a sequential basis, I think you have to look around and say, well, how is the Fed getting greater confidence if they didn't have the confidence to tee up a cut at 1.9, 6-month annualized core PCE, and now we're running closer to 2.5. So I think that's the kind of environment where it leads to you needing a lot of the narrowness that has supported the market in recent times to continue to be very constructive. That just leads to a narrower risk-reward path that, again, we land ourselves in a more neutral position.
Just quickly before you go, how much weight are you putting on the January data, the early data for 2024?
I would say not too much. The January effect does matter insofar as it's influencing expectations, and we've already seen some of the top bottom-up PCE and inflation forecasters that we track saying, well, there's the risk of this bleeding into February. So I think right now it's kind of just reset the clock on the degree of confidence the Fed needs and somewhat raise the bar that's required. Does it change our view fundamentally on the economy? No, not very much. Does it change our view on the kind of the balance of risks, particularly to risk assets? Yes, a little bit.
Can you just whisper your foreign exchange call, just in case Lisa reaches over the table and punches you?
Certainly, we really do think the dollar is a very good place to be, especially relative to G10, and that's again an assessment of the changing balance of risks. Right now, the kind of no landing, persistent inflation risk has become more and more central. The dollar, in our view, is just the top way to protect against that environment in which stocks and bonds are both selling off. And we do think that in that environment, the dollar is pretty much the only place where you get protection.
I'm not a violent person.
Thank you, Luke.
I
Appreciate that.
would never be punching
No, of course not. Never. Just in commercial breaks when people aren't watching.
Oh right.
Luke,
Yeah. I just
UBS.
do a left hook.
Look, thank you. Equities right now doing okay. She doesn't really, I promise. We're okay. We're okay. Nvidia in the pre-market up by more than 13%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. We're looking at President Biden. He is on a campaign fundraising swing through the West Coast, and he's sharpening his rhetoric against Russia and the Republicans. At an event in San Francisco, he called Vladimir Putin a, quote, crazy SOB, and laid into GOP frontrunner Donald Trump for comparing his legal battles to the death of Russian opposition leader Alexei Navalny. Biden's three-day California tour has included fundraisers that will add $130 million to his campaign coffers. And the head of Boeing's 737 MAX unit has been ousted from the company. Boeing says Ed Clark is stepping down effective immediately after nearly 18 years of service. The management change is the first since the door panel blowout on an Alaska Airlines flight earlier this year. And Boeing CEO David Calhoun is expected to meet with FAA officials in Washington next week as part of the ongoing investigation. And mobile users in the United States reported increasing trouble connecting early this morning, according to service tracking website Down Detector. AT&T, Verizon, and T-Mobile were among the carriers affected, with Down Detector reporting a spike and complaints at around 3:30 a.m. New York time. And that's your Bloomberg Brief, John.
Shonali, thank you. I was one of those complaints, I'm sure. Up next on this program, bank regulators under pressure.
The regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that.
That conversation is coming up next, live from New York City this morning. Good morning.
bigger challenge.
Listens next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Stocks on the S&P 500 firmer here, higher, rallying by 1.26% on the S&P 500. Nvidia check, you'll get many of them this morning. Stock is up by 12.5%, off session highs. In the bond market right now, Treasury yield shaping up as follows. The 2-year going nowhere, the 10-year down about a basis point, going somewhere to about 430, 431. Under surveillance this morning, bank regulators under pressure.
Regulator has to do their job and understand what's going on in the market. And if there's heightened concern, scrutiny associated with a specific segment, they're definitely coming in and spending more time looking at that. But I don't think it's anything out of the ordinary versus what would have happened if there was more concern within another sector.
Here's the latest this morning. The KBW Regional Bank Index is down almost 10% this year. Concerns around commercial real estate weighing on lenders and regulators alike, who are looking to avoid a repeat of last year's bank failures. There isn't a lot that First Horizon hasn't seen before. The bank is about to celebrate its 160-year anniversary, and the CFO, Hope Domchowski, joins us now for more. Hope, great to see you.
Good morning, John. Thanks for having me.
Pulled this quote directly from your website. First Horizon has served clients through civil war, 2 world wars, yellow fever epidemics, financial panics, the Great Depression, and the Great Recession. Worried about commercial real estate at all?
Yes, always worried. To make it 160 years, you have to think through every economic environment and be prepared to look at whatever's coming at us. And so we look at how do we underwrite through a cycle, and CRE is one of the ones that we do continually look at how will it perform.
Are you selling assets, slowing originations? Have you had to change anything based on the difficulties of other lenders? And I need to be specific about that because your stock has held up pretty well so far year to date.
We have not. We really run a client-first relationship model. And so these are clients of ours. We don't think of them as a loan. We don't think of them as portfolios that we would sell. We are lucky to have top-tier capital. And so we've been able to continue to lend to our existing clients as well as pick up market share from our competitors who have had to scale down their balance sheet or coming out of some of the markets that we're in, as well as shutting down some of their verticals. We're seeing some of our competitors completely get out of some of the products that we love, like mortgage warehouse, and so we've been able to lean in with our top-tier capital.
Just to sort of underscore that, have you been expanding those books in response to distress elsewhere?
We've been trying. The pipelines are really come down in the last 2 quarters. So last quarter was our first negative growth on the loan side. 500 basis points of rate increase has really stressed the sector. So as we look at the loans that are coming through, we see less loan demand and less that can really hurdle in this environment. We look at how will it perform through the environment. So even though we're at 500 basis points, we're still looking at we could see another 100 to 200 when we underwrite the loan. We don't think that's likely, but we also didn't underwrite loans 3 years ago expecting it to go up 500 basis points. And so it's a lot harder right now in this environment to originate loans that we think will make it through the cycle.
We talk a lot about where is the growth potential for some smaller banks, particularly in the profitability sector. And I was speaking with you offline and I said, where's growth? And you said, growth is a dirty word. Why is it a dirty word?
Well, for investors right now, growth in banks has been kind of tainted with the Silicon Valley failure, Signature failure, as well as First Republic. Those banks grew really quickly. And so as we're out on the road talking to investors, we're doing conferences, they're nervous about growth in banks too quickly. They see a lot of banks, as John mentioned earlier, selling off portfolios, shutting down some of their product lines, and they want to make sure the banking system is strong and stable. So our investors look at growth in this environment, a 550 basis point Fed fund rate as a little bit risky. And so as we are looking for loan growth, we're still hoping, we still are out there meeting our clients' needs and picking up market share. it is harder, as I mentioned earlier, and the investors know that. So when they see somebody that's picking up a lot of loan growth, they know that there's probably some risk to that. You guys have been talking about it more than I have, but nobody knows where interest rates are going. And so how do you have a lot of loan growth right now not knowing what that interest rate environment to underwrite to?
We talk about it far too much. We've been talking about M&A all week as well. Is this going to be the year of the regulator or the year of M&A?
I wish I knew, John. I don't think there was many banks more surprised to see a big deal go through than First Horizon. We were in May of this past year. We were a deal that was terminated after 14 and a half months of working with the regulators, going through the merger application process. The same week that First Republic failed, we were told that we were not going to get approval for our deal to happen. So we're really excited to see a new deal come through. This is the first big one since the TD First Horizon was terminated. And we're going to sit on the sidelines for this one and run our bank, but excited to see what happens. There's two things we're really looking at in the banking industry with this deal, which is, one, how quickly does it take? We used to see bank mergers go through in about 6 to 9 months, and the two before us that did get approved, they took 12, 13, and 14 months. That's a long time for an organization to be looking at a merger. So we'll be looking at, one, the timeline, but two, how easy is it to get a merger approved in this regulatory environment? And nobody knows right now. And this is a big one, so we're all anxiously watching to see how this one plays out.
Well, what your potential deal with TD has in common with this Capital One Discover deal is some of the calls from Congress saying they should block this. Elizabeth Warren came after that deal. She's also saying the same about this. So where does that leave the idea of M&A in the banking environment? Like, do you think in this environment it actually gets done? Kroger can't get done. Why would Capital One be able to get done?
I hope they can get it done, but we are sitting here, today seeing that the last deal that went through got declined. They are not publicly saying why they would not let TD Bank buy First Horizon Bank, but that there was some concerns they had. So I think the bigger issue for us in banking is scale matters. The cost of technology to run systems today that clients expect and the cost of preventing fraud is just astronomical, and it's increasing quarter after quarter. You heard last year a lot of regional banks increased their fraud costs. And with scale, you have the ability to better handle the client needs and prevent fraud. And I think that's one of the big ones that Discover and Capital One have been talking about, is how do they compete in the market without that scale?
If regulators do sign off on the Capital One deal, are you looking to be an acquirer, or are you looking to be acquired? Are there talks going on currently ahead of that potential allowance from regulators?
For us, no. We are happy to be running First Horizon. We're celebrating our 160th anniversary next month. Our company is really excited about our franchise. We're continuing to build our momentum in the marketplace. We're a Southeast regional bank. There's nowhere better to be the Southeast markets right now. We have the top market growth share, and we look at population growth, economic growth, and so we are not in merger talks right now. We don't have any desire to do one in the near term. Longer term, as we start to see M&A open up, we would look at what's opportunistic for us. The bigger thing for us is that $100 billion line for the capital bank, capital rules with Basel III. We really have to sit back and say, what is Basel III going to get implemented at? And what will that cost us going from an $83 billion bank to something over 100 with our next acquisition?
So what's the target? What's the sweet spot in terms of size, in terms of the types of businesses that you'd be in?
Well, for banks, I think JP Morgan is the only one that thinks they have enough size. If you're a $100 billion bank, you want to be 200. If you're under a $200 billion bank, you say you want to be 500. And the $500 and $600 billion banks are saying they want to be a billion, right? Or a trillion. So I don't think right now anybody feels they're big enough. I think Jamie Dimon would love to do another merger. Scale just matters, right? It is such, the game of banking is more and more expense coming in and more regulation that's impacting our ability to make money, whether it's the current interchange charges, the cap on, client overdraft fees. So revenue is getting capped as expenses continue to go up. And so scale is one way that we can improve shareholder value, by being able to spread those costs across a bigger client base.
Do you think a change at the White House would change the mood music in Washington towards regulation if Trump were to win again?
You know, we spent a lot of time talking about that with a lot of the, agencies and a lot of the policy groups we work with, and we're just not sure. We're not hearing a lot out of this campaign trail about how they will think about mergers going forward. It was a big one in the last, when Trump won the first time, he said, we're gonna make it easier to do mergers, we're gonna be open. We're not hearing that rhetoric this time, and so we really don't have a lot of indication just yet as to whether we would see any change with a possible Trump or Haley campaign.
That's absolutely fascinating. And I think that's your big frustration right now,
100%.
Grandma. There is this feeling, there is still this perception that lingers from the last term that the former president had, Donald Trump, that he would be business friendly and open to massive deals. We've talked about it a million times on this show. Then you see things from, say, Senator Hawley overnight, a Republican. You wonder which way the wind is blowing in the Republican Party.
And if you're wondering, this is what really frustrates me, you're not hearing about it. Instead, you're hearing name calling and all sorts of questions about, adequacy tests and different things of that nature, which just leaves business executives, investors, rank and file Americans in the lurch trying to understand what any of this is going to mean.
What is the policy? We're trying to find out. Hope, it's great to have you with us. You're going to stay with us, I'm pleased to say. Hope Domchowski there of First Horizon. Coming up on this program, Moderna beating estimates as the company gains vaccine market share. We'll catch up with the CEO, Stefan Bancel. He joins us next. Your equity market's positive by 1.3% on the S&P 500. Nvidia is absolutely flying. It's higher in the pre-market by 13%. From New York, this is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Stocks on the S&P 500, the rally continues. Equity futures on the S&P higher by more than 1%. On the Nasdaq, up by more than 2%. It is all down to this. Under surveillance this morning, Nvidia has done it again. The chip maker delivering yet another sales forecast that blew past estimates thanks to seemingly unstoppable demand for its AI products. Nvidia also saw fourth quarter revenue more than triple to $22.1 billion US. The company's market cap has increased by more than $400 billion this year alone, bringing its valuation to $1.7 trillion. And Lisa, maybe another something like $200 billion of market cap added at the opening bell this morning.
I don't understand these numbers. I mean, yes, they're big and they're getting bigger.
Huge.
And that's okay, great. But I don't understand the trajectory of exponential growth. How long can it continue? What is the multiple that you put on a stock that is growing more than 400% with respect to revenues in a year? Very difficult to understand, especially in light of the rally that we've already seen.
Know your customer. I think the customer base is really, really important here. This is a number that I wasn't aware of. Amazon, Meta, Microsoft, Google, the largest customers of Nvidia, 40% of its revenue. So if you're worried about where the revenue is coming from, we're talking about the most dominant firms on the planet that are absolutely minting cash, and this is where they're spending it. This company right here.
So if you're worried about it running out, don't be so worried, because they've got plenty of cash to spend, to your point. This is the issue, though. At what point is there pushback about how much the margins are, about how much they're charging for chips that they need for their cloud computing, generative AI offerings? So far, the sky's the limit. It seems like, even with China, it doesn't seem to matter when it comes to how much they can increase their revenues.
Stock is up by 13%. I've mentioned a few times we haven't talked about the Fed enough, so let's do that now.
Have you?
Kinda. Minutes from the Fed's January meeting showing members were united in delaying rate cuts. Only a couple of officials pointed to risk to the economy from waiting too long. Hotter than expected inflation prints since then are adding to concerns. JP Morgan's Marko Kolanovic seeing risks of stagflation. Writing this, investors should be open-minded that there is a scenario in which rates need to stay higher for longer and the Fed may need to tighten financial conditions. And then harking back to at least the 1970s for Marko and a team over at JP Morgan.
He's very much alone in that. I just want to put that out there. He's been alone on a lot of calls.
He's been quite lonely this year.
He's been lonely last year, too. But this is really a question going forward is how is the Fed going to respond to inflation that seems to be continuing? And how do we deal with what the ramifications of that is, considering what the ramifications are, considering that artificial intelligence has been such a game changer?
Yeah.
Does it even matter for so many companies? For the economy, sure, but does the economy even matter if you're invested in the S&P 1?
Based on these Fed minutes overnight, yesterday afternoon, there's going to be some Democratic senators that are pretty lonely, aren't they? Remember those letters they were sending to Chairman Powell? I'm not sure they registered.
Elizabeth Warren, Senator Whitehouse, sending these letters saying you cannot keep rates this height and restrictive. They're talking about issues for individuals trying to get on the mortgage property ladder. And when you look at the Fed minutes, it's only a couple of participants pointed to the downside risks, what this means for the economy. So there's a big gap between what some of these senior Democrats are saying and what the Fed actually thinks where we are right now in the economy.
Huge. That's enough of the Fed. Let's turn to this stock. Moderna, rising after the pharmaceutical manufacturer reported fourth quarter revenue that beat estimates. The company saying it captured a greater share of the COVID vaccine market in the fall. While it also expects regulators to approve its second commercial product this year, a vaccine for RSV. CEO Stefan Bancel calling 2023 a, quote, year of transition as we adapted to the endemic market. Stefan, I'm pleased to say, catches up with us again. Stefan, you've been a wonderful friend of this program over the last year or so. It's great to catch up with you again, sir. I just want to go to that market share story around COVID vaccines. How did you do that? Where did that come from?
So a lot of hard work and also being able to communicate to doctors that the two mRNA vaccines are not the same. And so if you look at the real world evidence, we have actually less hospitalization of people on the Moderna vaccine than the other vaccine. We've also been partnering with pharmacies to make sure we get the message out. So the team has done a lot of different activities to ensure that we get the share that we think we deserve. We had 30% share in 2022, and we're very pleased to have 48% share in the fall of 2023.
Stefan, do your investors still ask about COVID vaccines, or are they much more interested in, say, a melanoma vaccine or some sort of using this technology to prevent cancer?
I mean, both. If you think about Moderna, there is much more to Moderna than COVID. So on the one hand, they want to understand the COVID sales and how we're going to grow the COVID sales and layer on that RSV sales and then flu sales. Because the respiratory franchise is going to be an anchor to Moderna forever, because those viruses are not leaving the planet. But of course, we are very excited about the future. I mean, we have a 9 product in late-stage pipeline, including cancer, but also, rare genetic disease. And so it's a very exciting time for Moderna because they're getting the existing products, but they're looking forward to the sales growth delivered by the pipeline.
So on one hand, when you talk about RSV or you talk about COVID, there's the question, we were talking about regulatory risk, the regulatory boon of, say, the CDC coming out and recommending that everybody get these shots every year or mandating it for certain positions. Are you expecting that to be the case with things like RSV?
I mean, if you think about RSV, it is mostly a risk for the elderly and the very young children. So I think the current guidelines, of vaccinations for the elderly makes a lot of sense. And we were all very surprised, actually, about the number of people who got the RSV shot last year, It was much higher than any analyst had forecasted. So we're very excited because not only we have a great product in terms of efficacy, a very good safety profile, but if a product is approved by the regulators, which could come as early as May 12, that's the FDA PDUFA date, we could be the only product available to healthcare professionals in a pre-filled syringe. And that's really important. As you know, there's a lot of labor shortage in healthcare professionals, especially very acute in pharmacy retail chains. And if you think about the fall season, the pharmacists are very busy. They have to do their usual work, delivering a lot of products for people, and flu shots, and COVID shots, and now RSV shots. But the 2 products available on the market are pretty tedious. One of them is 9 steps of preparation. The other one is 4 steps of preparation. Well, Moderna, again, if approved, will be the only product that is pre-filled syringe. You take it out of the fridge, you clean the arm, you inject it, you put a Band-Aid, you are done. I really believe that healthcare professionals are going to be delighted with our product.
Stefan, that's what I wanted to ask you. You mentioned COVID, flu, RSV. So many vaccines individuals need to get in the winter. So if you had this one shot, it would save a lot of time, and frankly, it would be a lot easier probably and appetizing for people to actually go out and get it. But what is the timeline? When can we see that actually go to market?
So that's one of the other exciting news coming for 24 is we shared last year the phase 2 data of our COVID plus flu combo in a single dose. We should see this year the phase 3 data based on the platform that we have and what we've seen with COVID, with RSV and flu. I expect the phase 3 to be positive. If it is positive, we'll file it to regulator. So you could see this available in pharmacies as early as the fall of 25. So that's another exciting differentiation we will have versus traditional flu players and traditional COVID players.
Stefan, I know we're against the clock with you. You've got a busy morning. I just want to squeeze this in. The RSV shot, what are you learning about the durability of the protection it offers? Because as we understand, based on recent reports coming from you, maybe it doesn't last as long as the competitor and their offering does. And it makes me wonder, does that affect approval? Is that going to affect your competition against that competitor as you roll that one out?
Yeah, actually, if you look at the data, we're very confident about our profile. And if you look at the data of your vaccine, they also wane. And so if you look at what we're going to have in the marketplace, I think it's going to be very, very similar to what's available today. So I don't think that's going to be an issue at all.
Stefan, got to leave it there. We promised that you'd escape at about 7:38, so you can. Stefan Bancel, the Moderna CEO. Thanks, Stefan. Great to catch up. Thank you, sir. Hope Domchowski, CFO of First Horizon Bank, is still with us. Hope, I don't want to talk about the pandemic. I want to talk about what's happened since. Have you been surprised by how much has changed or by how much has remained the same?
Both. I'm very surprised by how much changed, and we thought the change was here for good, and now it's going back. If you talk about, let's start with remote work. Nobody was going to go back in the office. Everybody was efficient, and then you see a lot of CEOs saying back in the office 2 days a week, 3 days a week. We're back in the office 5 days a week for managers, 4 days a week for employees. We've seen a huge uptick in productivity, especially for our junior associates, that being in the office, that talking to people. And we're seeing our branches uptick again. We thought everybody had figured out how to use digital and nobody was going to go in a branch. Remember, there was talk, there's never going to be cash again. The U.S. system's going to go cashless. And so everything changed pretty materially, and I think we thought it was going to be for good, and we're seeing it swing back. You know, same thing as we were talking about CRE earlier.
Yeah.
We saw huge vacancy rates 2 years ago, and the expectation was everyone's going to just shed office buildings. You were going to hear huge corporate real estate headquarters just being shut down all across, and we're not seeing that, because even if you're in the office 2 or 3 days a week, you need a seat for those people.
You mentioned junior bankers. Are they coming back beyond the junior bankers, the whole staff? Are they coming back because they want to, or because you're forcing them to?
I mean, I would like to say it's because they want to. They will all say, I'm sure, it's because we're forcing them to. But there's a mix in it, right? We do still have the same flexibility we had before, but it's important to be in the office working together, getting to know your colleagues, that collaboration. We lost a lot of that with virtual work, especially as we were onboarding new employees. When you try to build a culture, one of the things First Horizon's very proud of is we have long tenured employees, and that leads to long tenured clients. And to build that relationship, that mentoring with our junior associates, we really saw that fall away.
So let's talk about what has changed. We talk about consumer behaviors, the YOLO trends, the fact that everyone's been traveling, the fact that people spend in a different way. How is that manifesting in your business, in what your clients are doing, and how you're sort of seeing opportunities in areas that are less appealing?
I don't think there's any areas that are less appealing. We love our clients and we want to be there for whatever they want to do. You know, on the consumer side, we haven't seen spending fall off the way that we thought it would. If you would have modeled 3 years ago, 500 basis points of rate increase, we would have thought we'd see a lot more unemployment, and we're just not seeing that. Consumers are very healthy in this economy. They still have discretionary money. In the commercial side, they're still employing. They're still creating jobs in our local markets. I love being in regional banking. One of the great things I get to do as a CFO is go meet with our clients and see the new projects they're putting up and go. I was in Middle Tennessee in December, and I visited 2 sites where we were creating 300 jobs in some of our smaller cities by the loans that we were giving. So we're continuing to see a really strong economy, especially in the Southeast.
Oh, this sets up the obvious question. Why America needs more than 4,000 financial institutions, why we need 4,000 plus banks when we don't see that model in Canada, we don't see that model in my home country in the UK. Why do we need it here?
I don't know that we need more than 4,000, but I'm not sure that we also want to go to 5 either. Right? The U.S. Economy is so healthy, and our average loan size for First Horizon for our commercial banks is $2 to $3 million. And so the clients that we're serving are not the same clients that are going to be able to get the loan terms from JP Morgan or Citibank that have, I don't know what their average size is, you might know more than me, but I'm sure it's not 2 to 3 million on commercial loans. It's probably 3-4 times that. And so the regional banks are really the Main Street banks. Our bankers are in the markets. They live there. They know their clients. They're excited to fund a new project that brings 100 jobs to their community. And so there is an ecosystem in the U.S. as a booming economy that the banking system here provides for.
We're looking forward to talking interest rates and the Federal Reserve with you. We'll do that in just a moment. Think this one over. Are higher rates good or bad for bank stocks? Because Lisa and I have been talking about that now for the last 18 months. Still haven't got an answer, have we?
Some people say it's the shape of the curve, that if you get an uninverted curve, that's going to be the change. And so that's the reason why we're struggling with this.
Hope is going to answer that question next on this program. Let's get you an update on stories elsewhere this morning. We can do that with Sonali Basak. Hey, Sonali.
Good morning, John. We're looking at the latest Quinnipiac University poll showing that a majority of voters think President Biden's age is a major issue heading into the election. 67% of respondents say the 81-year-old Biden isn't fit for a second term, and only 34% says he has the mental fitness to remain in office. Meanwhile, Donald Trump got slightly higher marks, with 41% of respondents saying he is too old to run. Trump is 77 years old and would be the oldest person to be inaugurated if he wins. Now, a woman billed as one of the most likely candidates to become the next CFO of Goldman Sachs is reportedly leaving the firm. Beth Hammack has been with the bank for 3 decades, and she moved into her latest role running the financing unit after being passed over for CFO in 2021. No woman has ever been appointed to the role of chair, CEO, president, or CFO in the company's history. Goldman and Hammack declined to comment. Now, Qantas and Air New Zealand have been impacted by aircraft delivery delays. Qantas said the delivery of its ultra-long-haul Airbus A350 would be pushed back, delaying the start of direct flights from Sydney to London and New York, while Air New Zealand now expects its new Boeing 787 Dreamliners to arrive next year, delaying the rollout of bunk beds in economy class that were due to be introduced on flights to New York and Chicago this year. That's your Bloomberg Brief, John.
Sonali, thank you. Appreciate it. Up next on this program, looking for clarity on the path to rate cuts.
We should not overreact to 1 month of data. Markets, in my opinion, really did, and I don't think the Fed did. They look through a lot of the noise.
Live from New York City, that conversation up next.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Live from New York City, good morning to you. Equities on the S&P 500 up by 1.2% on the S&P. NVIDIA is absolutely flying. Tweet of the day comes from Zero Hedge. I'm going to talk with guests about this. I think this is great. $2 billion delta between NVIDIA's revenue forecast and estimates translates in over $1 trillion in market cap gains this morning. All-time highs in the US, Japan, and Europe. More on that comment a little bit later. Under surveillance this morning, looking for clarity on the path to rate cuts.
They want more data. The data need to be good, not better. There are a lot of January effects. There were a lot of anomalies in that data. We need to see more, and yet we should not overreact to 1 month of data. Markets, in my opinion, really did, and I don't think the Fed did. They look through a lot of the noise.
Here's the latest this morning. Fed minutes from the January meeting showing officials warning against cutting interest rates too soon. Since that meeting, hotter than expected inflation data muddying the path to rate cuts. Kathy Jones at Charles Schwab sticking with her call, writing the Fed will likely initiate the first rate cut at the May or June meeting, assuming inflation continues to trend lower. Kathy, I'm pleased to say, is with us now. Kathy, let's get to that. Your takeaway from the Fed minutes yesterday, how stale were they?
They were a bit more hawkish than I expected because they contrasted with the tone of Fed Chair Powell's comments in the press conference. So I was a little bit surprised to see more reluctance on the part of the committee to initiate cuts. I don't think that changes the story one way or another. And I would agree with those comments from Claudia Sahm not to overreact to 1 month's figures. But it does seem to be more hesitancy than we thought there was at the Fed to start rate cuts. I guess they just need more data, as they keep saying, and they need more evidence that that inflation is going to stay down.
We now have to wait until July for the first rate cut to be fully priced into the market, although it's almost fully priced by June. And I'm wondering, Kathy, how you're thinking about what this new hawkishness, this one data point or two data points that doesn't necessarily make a trend but does make a market, how much that has affected your view going forward?
Well, we're still in the May or June camp. We've been sort of on the more moderate side of things all along, expecting the Fed to take its time. So I haven't changed that call yet. If we were to get a blockbuster employment number again, where we see huge jump in jobs or huge jump in wage growth, then we might push it back even further. But I think at this stage of the game, just like the Fed, we're waiting for more data to try to assess what they're thinking in terms of the first rate cut and the path after that.
Kathy, how much weight do you put on current market pricing? Do you think we should consider current market pricing just as a weighted average of multiple views? That's a view that's come up on this program a few times. We spoke to Mike Schumacher of Wells Fargo yesterday, who said that once the weakness kicks in, we're going to price in 200 basis points of cuts like that really fast. How much weight would you put on what's currently priced?
Yeah, it's going to vary. Like, we've seen so much volatility in expectations over the last year or so that I would agree that it's going to shift very quickly if we get real economic weakness, which we haven't seen. I mean, let's face it, the economy keeps chugging along at a pretty good pace. Even though inflation's coming down, the economy's pretty resilient. So I think that if he's right that we're going to see weaker economic data, sure, we'll price in faster rate cuts.
Kathy,
so there's room for the...
Just to jump in, forgive me, do you have a view on how big that cutting cycle would be?
So our expectation is that in this year, they'll cut 3 to 4 times, so 75 to 100 basis points. I'm not sure we're going to get to that terminal rate of 2.5% that the Fed has been talking about, because it does look like we have a more resilient economy. And if we get a productivity boom that at least seems to be slightly on the horizon, or we can be hopeful that we're getting an improvement in productivity, that raises our underlying growth rate and raises the underlying neutral rate. It's not inflationary, but it certainly can raise the neutral rate because our growth rate is stronger. So that might mean that the end rate is more like 3% rather than 2.5%.
Kathy, just before you go, one final question. Top call right now. We've had a 40 basis point repricing since the end of last month at the front end of the curve. What do you like and where do you like it across the curve?
You know, we still like investment-grade corporate bonds. That yield curve in the corporate bond space is positively sloped by just a little bit. So if you want to extend duration without taking a lot of credit risk, we still think that that's a good place to be.
Kathy, you're one of the best. It's great to hear from you. Kathy Jones there, Charles Schwab. Kathy, thank you. Hope Domchowski, CFO of First Horizon Bank, still with us around the table for some final thoughts. Hope, let's finish with this one then. I promised I'd ask this, so I've got to ask this. Are higher rates good or bad for bank stocks? Because over the last 18 months, we've had some difficulties.
The answer is yes, both. That's the problem, is there's not one answer for banks. First Horizon's an asset-sensitive bank. 70% of our balance sheet has repriced. And so we have one of the best margins and net interest income in the industry right now. So higher for longer is better for us. We're seeing credit really is still stabilized. It's, deteriorating, but really stabilizing to the pre-COVID level. However, there's a lot of banks that are liability sensitive, that are sitting on, underwater bonds and securities, and they need rates to go down. And I think that's the current issue. What's good for banks is certainty. As soon as we figure out whether it's going to be higher for longer, whether we're going to get down to a terminal, rate of 350, is it going to end up at 400? Then I think it's good for the banking system. Uncertainty on either side, rising or decreasing rates, is really hurting bank stocks.
How frustrating is it to you that smaller banks have to pay out 5.5% to their CDs holders and to their depositors, whereas the JP Morgans of the world can pay out maybe, 3% to their CDs because they are JP Morgan?
It's frustrating as a CFO, but as we look at the funding mix, but as I think about these are clients. We don't use our CDs, we don't use our money markets as a way to fund the bank. They're really long, deep client relationships. We announced after the TD deal was terminated, we went out and got 32,000 new clients for $6 billion of deposits in 45 days. And 98% of those, or 96% of those have stayed with us. And so when you're paying a client 5.5% as a CFO, you get a little bit more comfortable with it, but it is frustrating. The frustrating thing was how much of the non-interest bearing deposits left the regional bank during the banking crisis and went up to, the too big to fail banks and haven't quite come back down. That's the harder part for me.
That's where I wanted to go.
Free money, right? It's just free.
So that's where I wanted to go. How difficult has it been to retain those non-interest-bearing deposits? Have you been able to attract them back due to the relationships, or has that ship kind of sailed?
I don't think it's sailed. It's getting harder. We've had to push more into marketing than we've had to push in probably a decade on the retail side of acquiring new clients. We've had to do a lot more with our branches. As I mentioned earlier, more and more people are coming into branches. It's amazing. We have a brilliant chief marketing officer who's done a great job. And the first time she's like, I need this much money to send out mailers. I was like, who looks at mailers? And yet we saw the campaign results and people still walk into a branch with a mailer and say, I want a 5.25% CD. And so we're having to get back to kind of old banking tactics that in zero rate environments, people weren't shopping their deposit accounts.
It's amazing. Can we just finish on deposit insurance just quickly and regulation? What kind of reforms are you advocating for at First Horizon?
The biggest one for us at First Horizon is the tailoring in Basel III. Treating a $100 billion bank like a $1 trillion bank for long-term debt, capital hold, it is a really hard pill for us to swallow. For us, we estimate that Basel III, if implemented with the TLAC and the long-term debt, would be about a $75 million expense add to our $2 billion expense base. How do you tell shareholders that tripping over $100 billion is that much more valuable to them when we have to add that much more long-term debt onto our balance sheet?
We've heard that a lot. Lisa just wants to know whether you're sending out toasters to get people to open up accounts.
Mugs. You know, that comes up a lot. We've been asked whether people should have toasters. Bobbleheads were a big one during, you know.
Of who? Are you going to have a bobblehead of you?
Well, I grew up in New Jersey, so I still have a Derek Jeter bobblehead. Back when the Yankees used to give out bobbleheads. Do you remember that opening day? Yes.
That's amazing.
Oh, Mets fan? Well, they probably didn't give out bobbleheads.
I'll just take the cash. I'm happy to deposit wherever.
Exactly.
I'll just take the cash. Remember the cash bonuses?
Okay,
They're still around.
My first account, and I was like 11 or something, a child account, I got a little folder and I got little pens, and it was very exciting for me, but I was 11.
I'm still with that bank in the UK. Same one.
Seriously?
First one, same one.
Can I open a new account for you, John?
We can do that.
We might be able to get you a bobblehead if you want one. I can call my chief market officer and I need one bobblehead.
I'll take that. I'm not sure we can negotiate this stuff live on air, but I'll take a cash deposit, a toaster, a bobblehead, and whatever else is going. Hope it's good to see you.
Thanks, John, for having me.
Thank you so much. Thank you. In the next hour of Bloomberg Surveillance, Mona Mahajan of Edward Jones, Henrietta Trays of Vader Partners, Michael Dada of Roth MKM, and Gene Soroka, Executive Director of the Port of Los Angeles. The third hour of Bloomberg Surveillance is coming up next with equity futures on the S&P higher by 1.3%. Nvidia still flying.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg.
We're not really sure when the Fed goes the first time. Is it June? Is it July? For most reviewers, it simply doesn't matter.
The Fed is steady as she goes in many ways, and it's creating, I think, a lot of volatility.
I think inflation is stickier than maybe some folks would have thought.
The lumpiness in inflation is just part and parcel of going through what we're going through, a normalization of interest rates.
A lot of the inflation data that we saw recently was largely seasonal, and that will reverse in the next couple of months.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance with a focus on one name, NVIDIA. It is the best performing stock on the S&P 500 over the last 12 months, year to date, and this morning too. The stock is higher by almost 13%. The numbers are amazing. The price reaction is incredible. So let's start with the numbers, and then we can talk about the price action elsewhere. The numbers, revenue more than triples to $22.1 billion US dollars. Go back to 2021, they didn't even generate that much revenue in an entire year. The profit's incredible, reporting a 486% year-over-year growth in earnings per share. Okay, you've registered that. So let's talk about the reaction to the outlook. This from Zero Hedge. I think we need to chew over this because they're on the money. A $2 billion delta between NVIDIA's revenue forecast and estimates translates in over $1 trillion in market cap gains this morning. We've got all-time highs in Europe. We're back to the highs of 1989 over in Japan, and the US maybe is going to make a high of its own a little bit later.
We asked the question, how do you extrapolate out exponential growth at a company that does seem to be at the vanguard of a sea change in society? And the question is, this is how you do it, really imprecisely with a dartboard, basically throwing it at it and just saying it's going to keep going up. And that's essentially what Zero Hedge was pointing out. But this is the issue. When do you stop? When do you go neutral, to Luke Cowher's point, which isn't a bearish neutral, it's just a how much further can we go neutral?
AMH, we talked about the career risk of not being long this name based on these gains we've seen, not just over the last few months, over the last 12 months plus.
Well, yeah, overnight there was one lonely seller last night who now is a hold this morning. So no one is saying on Wall Street, if you look at that.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel, hence I did that all in one. The idea is you pressurize the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave.
My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Banking sector, do they actually think this deal can go through when senior Republicans and a senior Democrat are saying, absolutely not?
Hope Domzhalski of First Horizon with us just moments ago, and I think she got to the heart of the issue, big time. And the frustration that you have, Lisa, with the political debate of the moment. Here's the problem. There is a view, based on the last administration, that the former president, if he becomes the next president, will be easier somehow for business, that these deals will just come together, executed, and we'll move on. Based on what we heard from Senator Hawley yesterday, and according to Axios, that letter that they produced, I wonder which way the wind is going to be blowing in the Republican Party, given this populist stance that's quickly emerging on this front.
And if the wind where the wind blows is where people's views are going to be. How do you create policy if you're an executive with an actual balance sheet and actual money you got to put to work? This is the frustration with Washington, D.C., and the reason why I'm trying to remain engaged and disciplined throughout this process.
You want to talk Washington, you want to talk policy.
100%.
And that's the issue, we're not talking policy.
I mean, whether it's the deficit, whether it's actually which mergers are accurate, whether it's how to protect a regional banking system that did experience stress and did experience a flight of non-interest bearing deposits, there are some real issues. This question of entitlements, this question of our international footprint after years of having a reputation that really were hinged on that. All of these things are valid conversations that we should be having.
They don't always win elections.
They don't win
Who wants to
elections.
get up on the podium and talk about the deficit and cutting your entitlements? No one.
That's why I've got a bit of an issue with politicians, in case anyone wasn't aware. Anyway, equities right now on the S&P 500, firmer by 1.2% on the S&P. In the bond market, yield to look like this, a little bit higher by 2 basis points, 433.65. Coming up this hour on the program, Mona Mahajan of Edward Jones on why she doesn't see bubble behavior for AI stocks. Henrietta Trays of Vader Partners on bipartisan efforts to stop the Capital One Discover deal, and Port of LA Executive Director Gene Soroka on global trade disruption. That one is a must-watch a little bit later this hour. We begin with our top story, global stocks moving higher on the back of NVIDIA's blockbuster earnings. Mona Mahajan of Edward Jones seeing more room to run, writing this: we don't see bubble behavior in this AI cohort because the earnings and growth opportunities seem quite real. In this backdrop of pending Fed rate cuts, inflation potentially moderating, and the economy showing scope for re-acceleration in the back half of the year, we believe remaining fully invested is a sound strategy for the year ahead. Mona is with us right now. Mona, I want to go to that quote we've been referencing from Zero Hedge. I understand the numbers are tremendous, but let's talk about the price action and the response to them. They're pointing out quite clearly, and we can see it in the numbers, there was only a $2 billion, I say only, but given the stock we're talking about, that matters, only a $2 billion difference between the revenue forecasts and the estimates, and it's unleashed the monster of all rallies. Mona, what explains that?
Yeah, you know, thanks, John. And look, I think there's a couple things that we can take away.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurize the handle, The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Discretionary, and all the Magnificent Seven is housed there. So if you are an investor, even invested in index ETF, you have about 50% exposure to large cap technology. And so it almost has become intertwined with investing in the US market. From our perspective, it does make a lot of sense to be involved early on in some of these gains where we see this long-term secular trend emerging. Over time, we would expect, as we noted, a broadening of leadership. We do think, if we are in a cycle where we're not only in a generative AI cycle, we're in a Fed potentially rate cutting cycle. And by the way, there's an election cycle coming up in the background as well. But we do think in that backdrop where the Fed may be cutting, where you're probably going to get over time at least better inflation trends, and that those both will help the consumer and the economy, we may see early cycle behavior reemerge, and that includes a broadening to areas like cyclical parts of the market, areas like small caps and mid caps, and perhaps even international play some catch up as well. So we want to make sure that we are diversified, but we don't want to give up that 45% exposure to the S&P 500 large cap technology space.
Are U.S. government bonds diversifiers still?
Yeah, we still think in this environment where yields are still relatively high, we don't see the Fed coming back to the zero bound. We think they'll stay somewhere in their neutral range of 2.5% to 3% longer term. That still is a pretty good environment for investment grade bonds. And if you think about, the environment post-crisis where we were at the zero bound, it was a primarily growth story. We think the next 5 to 10 years look like growth and value, but importantly, bonds do play a more meaningful part of your portfolio. And if you think about duration broadly, of course, at this point, you're not only locking in, if you do extend your duration to some extent, especially away from those CDs and money market funds, or at least complement them, you're locking in some of these better rates for a longer period of time. You have the potential still, we believe, for price appreciation as the Fed begins its rate cutting cycle. And so very much, yes, we think bonds are actually going to become a mainstay in portfolios more than we've seen really in any time in recent history.
I asked this of Ben Gooderidge earlier today. Are you bearish on anything?
What we'd say is we want to be cautious about, last year was a trade of Magnificent Seven, mega cap tech, and probably CDs and money market funds. So we want to be cautious about remaining too overweight in those cash-like instruments. And we've seen a little bit of that complacency and that behavior from investors who have benefited from 5% plus yields. Keep in mind, there is some reinvestment risk on the horizon as the Fed starts cutting rates. There is an opportunity cost to those, CDs and money markets, especially as we've seen, S&P has been up 24% in 2023. We're up, 5 to 6% this year already, well exceeding, money market rates. And so that's the only area that I'd say just be mindful of, the complacency that comes with just reinvesting into money markets and CDs.
Mona, thank you. Appreciate the answer. It's the same as the answer to the last person who answered that question. Mona, thank you. Mona Mohammed-Jan of Edward Jones. It's like spitting in a bear's face. What are you bearish about? Cash. That's what I'm bearish about.
Literally. That's a great way of putting it. It's basically everything that you like, we don't like because you're too cautious. This is just sort of giving you a sense of how full bull everyone's gone.
Equities right now, full bull, up by 1.2, 1.3% higher on the S&P. Let's get you an update on stories elsewhere this morning. morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. The head of Boeing's 737 MAX unit has been ousted from the company. Boeing says Ed Clark is stepping down effective immediately after nearly 18 years of service. The management change is the first since the door panel blowout on an Alaska Airlines flight earlier this year, and Boeing CEO Dave Calhoun is expected to meet with FAA officials in Washington next week as part of the ongoing investigation. Now, minutes from the Fed's January meeting showed that most officials remain more worried about the risk of cutting interest rates too soon than keeping them too high for too long. Policymakers want to see more evidence that inflation is firmly on a path to their 2% target before they lower interest rates, with some concerns that progress could stall. Officials agreed that interest rates were likely at their peak, but the exact timing of the first rate cut remained unclear. And we're also watching President Biden because he is on a campaign fundraising swing through the West Coast, and he's sharpening his rhetoric against Russia and the Republicans. At an event in San Francisco, he called Vladimir Putin a, quote, crazy SOB, and laid into GOP frontrunner Donald Trump for comparing his legal battles to the death of Republican opposition leader Alexei Navalny. Biden's three-day California tour has included fundraisers that will add $130 million to his campaign coffers. And that's your Bloomberg Brief, John.
Shonali, thank you. Angry Biden is part of the strategy. That's the campaign strategy now. Angry Biden.
Yes, he has been angry. He has come out with a little bit of a temper, which he's known to have, and he's kind of sounding off. And he does this more so when he gets into a room with donors at a campaign event.
Yeah, but do you think this is really about the campaign who believes that this shows and demonstrates he's more engaged? That he's not a fragile, disconnected old man?
Potentially.
He's more engaged, he's angry about these issues?
Well,
is that what this is about?
Because we're sitting around the table at 8 a.m. talking about it. So potentially that is working.
Anger sells, period, full stop. Whether it's populist anger about credit card bills or whether it's the anger that people feel when they log on to social media, and that's what sort of is the algorithm.
What's also interesting, he was talking about climate. This is the full quote. This is the last existential threat. It is climate. We have a crazy SOB like that guy Putin and others, and we always have to worry about nuclear conflict, but the existential threat to humanity is climate. So it was within a pitch about climate that he mentioned this Putin SOB.
Okay. More Angry Biden coming up later this year. Up next on this program, Senator Hawley and Senator Warren agreeing on something.
The kind of pro-competitive impact of strengthening Discover as a competitor to Visa and MasterCard going to be more compelling when it actually goes to litigation, if it does.
That's next on the program, live from New York City. This is Bloomberg.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Allergy to any kind of concentration. So the pressure to scrutinize it, I think, is very intense. Certainly to draw out the review. I see no reason to think this is going to go through quickly. How it goes in courts is a different question, I think. The kind of pro-competitive impact of strengthening Discover as a competitor to Visa and MasterCard is going to be more compelling when it actually goes to litigation, if it does.
Here's the latest this morning. Republican Senator Josh Hawley joining Democratic Senator Elizabeth Warren in speaking out against Capital One's proposed $35 billion mega deal to buy Discover. Hawley writing this, sounds like the credit card companies are finding another way to screw the American people. This merger should be blocked, and Congress ought to cap credit card rates pronto. Joining us to discuss antitrust is Henrietta Trace of Vader Partners. You get the good stuff this morning, shutdowns, antitrust, these two agreeing with each other. What is that about? Where do you think the wind is blowing in the Republican Party? Is Hawley alone, or has he got company?
I think Hawley's in good company, and he's bringing more people to the party. As Lisa said before, anger sells, and it brings all the girls to the yard. The most important person to watch, though, is always going to be Sherrod Brown in this situation, and his commentary is much more sanguine. He's in a very difficult re-election race right now. He's not going to allow anything to happen that upsets and ruffles feathers. So if you want to skip over the anger and exciting TV, that's where you would go and follow.
But he still put out a letter almost immediately saying they need to look at this.
Yep.
What could Congress do? Because obviously this lies with the FTC and the DOJ.
I mean, I'm afraid to answer that question because Congress obviously can't do very much, right? They can barely keep the lights on. So I don't anticipate much beyond maybe a hearing. I can't anticipate them getting too in the weeds for the regulators who will very much be doing this of their own volition. Members are going to talk about it, but I don't think they'll do much.
Speaking of keeping the lights on, they're struggling to do that. Potentially next week, we could see a government shutdown. The Freedom Caucus is saying this: we're not going to secure significant policy changes if we're not going to do that, or even keep spending below the caps adopted by the bipartisan majorities less than 1 year ago. Why would we proceed when we could instead pass a year-long funding resolution that would save Americans $100 billion in year one? They're talking about this McCarthy-Biden deal. What's your expectation? Because they have basically 2 days to get this done.
Yeah, exactly. They have 2 days, and it's only $300 billion worth of the overall government spend. The big tranche is not till the following Friday when we get $1.2 trillion that would fall off. Effectively, what I think here is we'll get another short-term CR because those $100 billion in cuts go into effect May 1st. We're just waiting and kicking the can till then. So the reason I'm up here and talking to clients is basically to say we're going to have one more punt. And then in mid-March to mid-April, we'll get a big deal that'll tackle the sequester. It'll tackle, Ukraine-Israel border, maybe something to do with the tax bill potentially, although I have low odds there, and a $55 billion domestic aid package.
But the Freedom Caucus letter to Speaker Johnson basically proves this very difficult position he's in. He either deals with the Democrats and keeps the government open, but deals with the Democrats and loses his job. Is that a potential for him?
I think the losing your job potential is real. However, that October period when they went 3 weeks without a speaker is something that's still very fresh on the Hill. If you go and talk to members, they remember how awful that was. And be mindful that they went through many members on their roster. It's not like there's folks waiting in the wings to step in as the next speaker. So I don't think Johnson's at immediate peril. I think he can get one more shot on goal with another short-term CR. And then the real fight will happen in April.
So when you talk to clients who are in the market, what do they do with this?
I mean, there's an understanding that on Friday, it's only $300 billion. I've been with clients all week, and they're basically like, oh, this one doesn't matter. No one cares about these. It is military construction VA, amongst others, energy and water, transportation, HUD. It's not irrelevant or anything, but you can see from the temperature and urgency on the Hill, no one really much cares. It's the following Friday, March 8th. And the interesting thing about that week is that Super Tuesday's on the 5th. The State of the Union's on the 7th, and the real government shutdown's on March 8th, so it's going to be a lot.
Just to go full circle, it used to be that the Republican Party was considered the party of business. Is it still?
No, definitely not. You can talk to the U.S. Chamber of Commerce about that. They do not have that business lobby that is able to just railroad through the Republican Party, whatever they say goes. Now it's a tremendous amount of pushback. I hear things from Senate Finance Committee and tax staff basically saying, we didn't get any points for lowering the corporate tax rate. And then the business community came back and suspended fundraising after January 6th. There's a lot of hurt feelings, and that animosity grew and exploded during the Trump administration, and it has not cooled off. In fact, I think it's gotten quite a bit worse.
I think this is really interesting then, because there is this lingering perception, lingering from the last administration, that Trump is business friendly, and we'll get more of that if he gets back into power. Are you saying maybe we won't?
I think Tom Donahue in the U.S. Chamber of Commerce would tell you that he is not business friendly, and Republicans will go to the mat to combat ESG aggressiveness, any kind of corporate wokeism. We didn't get a tax extenders bill last year when we very easily could have, and I don't think we're going to get one this year, because the R&D tax credit, the EBITDA to EBIT shift, the bonus depreciation provision, those are giveaways to corporations that are not necessarily exclusively siding with Republicans anymore. They donate to Democrats, and Republicans remember that thing.
What kind of policies are you expecting then out of a Trump administration if it is indeed the next one?
We're going to extend the 2017 tax cuts. Just keeping things neutral will cost $2.7 trillion. And one of the things I find really interesting is that the street considers that a fiscal easing. But it's incredible because if you look at history, since tax cuts started, you can go back to Reagan, they don't go up. They just keep going down, and we get extenders packages. The same thing happened in 2010 when we extended the 0103 tax cuts, again in 2012, both under Democratic presidents. And that's what the Democratic agenda in President Biden's budget is very likely to show when it comes out. Most, if not all, of the tax cuts for individuals at least under 500K are going to be extended.
Given the cost associated with that, are you saying that once they've done that, there's not much space to do anything else?
They don't raise taxes. They cut taxes. They do not raise them. They let some expire, but that's as close as they get.
Henrietta, it's great to see you. Good to see you here in New York. Henrietta Trey's there at Vader Partners. Bramo, I think that got to some of the issues you focused on.
Yeah, the fact that essentially there's not going to be any financial discipline in Washington. So this raises this question about auctions. There was a 20-year auction yesterday. It didn't go that well. It's not because of the deficit, but anyway.
20-year maturity is an odd one.
I know, but it still causes off. Whatever, but moving on. There really raises a question. They're not going to deal with taxes only go down. They don't go up, right? And guess what? Entitlements don't go down either. So what has to give, and when does this become a real conversation?
Peter Chair of Academy Securities is talking about exactly the same thing. Brendan Murray, our colleague out of London, wants us to ask, a Chinese-made port crane spying on us, which seems to be an issue at the moment. Port of LA director coming up a little bit later. Cybersecurity effort coming from the president as well. That's actually a focus in some ways,
Well, very much so.
Well, front page of the New York Times this morning has a lot to do with this in terms of Chinese spying on a bunch of companies as well as U.S. allies around the world.
That's the back half of the show. Look out for that. Coming up next on the programme, before we get there, breaking jobless claims. We'll get you the reaction with Michael McKee and Michael Dowder of Roth MKM from New York City. With equity futures on the S&P 500 positive here by 1.3%. Live from New York, this is Bloomberg.
So the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Equity futures on the S&P 500 shaping up as follows. We're positive here by 1.3%, about 1 hour away from the opening bell. In the bond market, yields are higher by a single basis point. Your 10-year 433.45 in foreign exchange. The euro 108.39, positive here by 0.2%. Waiting for jobless claims. The estimate is 216. The previous number is 212. Jobless claims exceptionally low. If you take the chart, stretch it back decades. We haven't seen numbers like this one. And Mike, it gets better.
It gets better. And this is interesting news because this is the week that represents the February payrolls survey. 201,000 initial jobless claims last week. That's down from 200 and, well, what it was last week. It's a decrease of 12,000 from the previous week, so we only went up by 1,000. So 213 last week, 201 this week. Continuing claims up to 1,862,000. Actually, that's a decline from a revised 1,889,000. The continuing claims are a week behind the initial claims, so because the initial claims fell last week, we're catching up with the continuing claims. But basically, the bottom line of all these numbers is nothing wrong with the labor market at the moment.
Amazing. Let's just run through the boards, Mike, very quickly. In the equity market, still near session highs, up by like 2% on the NASDAQ 100, on the S&P 500, up by 1.25. The equity market, because of NVIDIA and AI, could not care less about what's going on in the bond market, seemingly. But we should talk about what's going on in the bond market. We've got a 4 basis point move higher at the front end of the curve. The 2 years just gone through 470. So if you go back to when the Fed last met, at the close that day, the 2 year closed at something like 420. So we've repriced yields higher by 50 basis points off the back of decent payrolls data, hot CPI, hot PPI. The ISMs were pretty decent as well. And now jobless claims, Lisa, dropping back to 201,000.
What I find interesting is not so much the front end response, it's what we're seeing in the 10-year yield. It's now at the highest going back to November of last year, and it's rising actually faster. And this, to me, is raising a question about whether people are now considering what happens when you get strong growth despite 5.5% Fed funds rates. Does this mean that the actual inflation rate is going to be higher and that the growth rate is much greater than many people think?
The stock market is ignoring this. The bond market is not. FX market isn't either. The dollar is stronger. The euro is almost unchanged on the session now at 108.27. Mike McKee, let's talk about this. This data over the last month or so seems to be shaking up market-based expectations of the Fed, but doesn't seem to be shaking up the Federal Reserve just yet. How much weight are you putting on it?
Well, we put weight on it because obviously the data are suggesting something is happening in the economy. The question is, these are all one-off so far. One CPI report and basically one jobs report that revised a previous one. We have to see if that's continuing. But you go to the minutes yesterday, and usually the minutes don't mean a whole lot. But in this case, the markets have taken it as having some meaning because the Fed was pushing back against the idea of early cuts, which was the market thinking at the time. But now the market is taking this as, well, maybe they knew something that we didn't know about how strong the economy was. So right now we're seeing a repricing toward where the Fed has been, so it's not going beyond that yet, and it does tighten up financial conditions, which helps do the Fed's job for it. You mentioned the potential growth rate maybe being higher. That's going to be the next debate, is when the Fed starts cutting, how low do they go? There's already been comment from Fed officials about the possibility that the neutral rate is higher. We'll see if they can calculate. I mean, when you look at the calculations, there are about 20 different models. It seems to be a little bit higher, but does it stay there?
You said financial conditions are tightening. Sure, you get a couple basis point move and the bond yield higher, but we just heard from person after person the biggest risk out there is having cash, because you really just need to be invested in absolutely everything because it's going to be an amazing year. At what point does that become problematic for a Federal Reserve that did give a nod to that in the meeting minutes by saying that this could stall some of the progress on disinflation?
Katie Greifeld and I yesterday were reminiscing about Alan Greenspan and his irrational exuberance comments, and the fact that then the market a couple of years after that blew up. Does that happen again? We don't know. When you say invest in everything, it's basically invest in 7 things, it seems like. So the Fed looks at that and says, what about the rest of the market? Is the rest of the market being overpriced, which we saw in the late 1990s? And the Fed officials I've talked to have said they don't think so at the moment. They're keeping an eye on NVIDIA and all these others, because obviously bubbles can pop if it is indeed a bubble, but it isn't broad.
Mike McKee, thank you, sir. Equity still near session highs at 1.3%. Let's run through it. Bond yields are higher off the back of hotter than expected jobless claims. The right kind of downside surprises, we like to say. Yields are up by 3 or 4 basis points through 470 on a 2-year. Lisa looking out further along the curve, up 2 or 3 basis points to 434. Dollar just a little stronger off the back of this against the euro, 108.32. You can see this on the chart as jobless claims drop. Dollar strengthens, euro just a touch weaker. On the session still, the euro against the dollar is positive by about 0.1%. Mike Dada of Roth MKM joins us now to get into these numbers. Mike, let's talk about them right now. Jobless claims coming at 201. We're looking for 216. Previous week, 213. How much weight, Mike, are you putting on this data? Payrolls, hot. CPI, PPI, hot. ISM, decent. Claims, lower. How much weight are you putting on that?
Yeah, thanks for having me on, John. If we just focus on those, I mean, the discussion would probably rapidly shift to when is the Fed going to raise rates again, which you at least have a small minority of folks talking about. But we had some other data that was actually quite soft. Retail sales for January missed, fairly weak internals, industrial production and manufacturing were also soft. So in the broad context, I think the data is more mixed, but no doubt about it, those Fed minutes I do think were revealing in the sense that we do see the Fed continuing to push back on both the timing and the magnitude of the easing that was expected coming into the year. And one of the things that we've been writing about is, the consensus view seemed to shift to this idea that we'd have no recession or an economic acceleration, double-digit profits growth, and 6 rate cuts anyway. And that didn't seem to make a lot of sense. Our view was you get the rate cuts if the economy really weakens, and if it doesn't, then the Fed's going to be, pushing back on those expectations. And that's what we have here with the 10-year yield now up into the 430s, the last I saw.
Mike, you said timing and magnitude. Talk to me about timing, and then we'll get to magnitude. What kind of timing are you thinking about now?
Well, it's interesting. I mean, the Fed funds futures markets, the implied yields over a 3-year horizon, I think are up about 70 basis points from the lows last year. So that's a fairly big move. That explains why the 10-year yield is rising. We're not really seeing a breakout in bond market inflation expectations here, but it looks like, the cuts now have been pushed, not just from starting in March to May, but perhaps not until this summer. And it'll really depend on the data. What Fed Chair Powell is saying is that we don't know where the neutral interest rate is. Tom likes to say the Vixillian equilibrium rate. It'll depend on how the economy performs. If the labor market is holding up, if so-called financial conditions are accommodative, then the Fed is not going to have a compelling reason to start cutting rates in any meaningful sense. And so I think it really is data dependency to an extreme for the Fed here now.
So, Mike, let's talk about the data. We can have 12 months of economic data. Look at 2023. Growth was strong. Unemployment was low. It was south of 4%. Mike, we were at 5.5% through much of the back half of that year. What did we learn from that?
Well, what I learned was that I think we had a fairly big positive supply side shock last year. That was really the surprise. If we look at real growth, it accelerated last year. Nominal growth actually decelerated. And that is the textbook supply and demand definition of a positive supply shock. Yet some of the early reads on inflation coming into this year don't look so hot. You mentioned the CPI, the PPI was also hot, so we're probably looking at a fairly warm PCE deflator for January as well. So if that positive supply side shock is mostly behind us, then I do think we're going to see the economy decelerate through the course of the year. But expectations are pretty high here given the surprise last year, which is that real growth accelerated. But for the Fed, they really control nominal variables. So if the policy stance is restrictive, then one would expect nominal growth to slow. That's been happening and continue to slow. The question is, can the Fed really thread the needle here on the neutral rate in a way that preserves the business cycle? And that has been yet to be seen, even though you had a lot of people jumping up and down and taking victory laps on the soft landing last year. Sure, soft landing so far, but the final chapters haven't been written just yet.
There's a lot to unpack there. I want to just sit, though, on the idea that continuing claims fell last week, and that this is going to be one of the key contributors to the February jobs report, given the fact that we're looking at a decline in initial jobless claims on the week. Mike, at what point does this data speak to a resilience that you were not expecting that makes you change some of your expectations for the year?
Yeah, I mean, I certainly think that, the claims data has surprised to the upside, no doubt about it. We did see a spike in both initial and continuing claims last year that now seems to have unwound. In fact, we were getting a fairly strong recession signal out of the continuing claims data, up year over year, 20+%. And now those numbers have started to pull back. So we'll see whether that's sustainable. One thing that makes me a little bit nervous about just completely embracing the claims data in an unadulterated way is that the NFIB small business data that we got for January, the hiring plans index made a new cycle low in January. That's a very powerful, although a bit volatile, 6-month forward indicator for the unemployment rate. Sometimes claims actually tend to lag the cycle a little bit. Going into the 07-09 downturn, jobless claims really didn't make a recessionary move until the spring of 08. And so they're important. Let's watch the claims data. Let's give them credit for hanging in there. The picture looks good if we just isolate the claims numbers, but there's a broader story to tell here.
Is that broader story that you still see recessionary signals later in the year?
Yeah, I'm still worried that we haven't soft landed yet. I mean, I think the Fed is going to really be pushing back on the timing and magnitude of the rate cuts, and that does create the risk that if and as things slow, we think they will, the Fed will fall behind the neutral rate curve, and that's how business cycles tend to end. We've had 18 months of an inverted yield curve. So, historically, that's fairly rare. When we have seen that, we've either been at a cycle peak or about 6 months from recession. So the lags do look longer here than the average historically, but we're just not quite out of the woods yet. And the consensus view seems to be, pretty coalesced around this idea that we've successfully soft landed. We really are out of the woods. We've dodged the recession bullet. And that's really not our view.
Hey, Mike, it's another hot data point. Mike Dada of Roth MKM. Appreciate it, Mike. Soft landing so far. Mike's words, the final chapter hasn't been written yet. The data looks pretty tremendous again. Jobless claims dropping at 201, the estimate 216. Need to get you an update on the network outages here stateside. Here with your latest is Bloomberg's Sonali Basak. Hey, Sonali.
John, the latest is that AT&T, the largest wireless carrier in the United States, is confirming network issues and service disruptions. According to Down Detector, thousands of customers reported issues starting around 3:30 a.m. Eastern. And AT&T spokesman Jim Greer saying in a statement, quote, "We are working urgently to restore service, and we encourage the use of Wi-Fi calling until service is restored. The cause of the issues or the number of people affected remains to be seen. Verizon and T-Mobile both say networks are working normally." Now, the latest Quinnipiac University poll shows a majority of voters think President Biden's age is a major issue heading into the election. 67% of respondents say the 81-year-old Biden isn't fit for a second term, and only 34% say he has the mental fitness to remain in office. Meanwhile, Donald Trump getting slightly higher marks, with 41% of respondents saying he is also too old to run. Trump is 77 years old and would be the oldest person to be inaugurated if he wins. Google is pausing image generation of people on its AI service Gemini. The platform is coming under criticism for how it handles race. Users on social media pointed out historical figures, including popes and founding fathers, were being portrayed in a variety of ethnicities and genders. Google responded, saying Gemini's AI image generation does generate a wide range of people, and that's generally a good thing, but it's missing the mark here. That's your Bloomberg Brief, John.
Shanali, thank you. I'm not going to comment on that story. I'll avoid that. Can I just say, turning around and telling people to use the Wi-Fi is the most ridiculous thing I've ever heard. I mean, seriously, what did they think we were going to do?
Yeah, exactly. Just not use the phone.
Oh, yeah, sure, yeah. I hadn't thought of that. Thank you.
How many hours has it been before they actually acknowledged it?
It's literally been more than 5 hours.
Exactly.
No offense to any engineers that are listening to this, but it's like when they tell your computer's not working, well, did you turn it off and turn it on?
This is what it feels like.
Yeah.
Turn on the Wi-Fi. Hadn't thought of that. Thank you, AT&T. Appreciate it. Up next on this program, global trade disrupted.
We have rejigged our network completely, sailing everything south of the Cape of Good Hope, and expect to do that for a while until we have really safe passage reopened in the Red Sea. So this could be with us for a while.
That conversation up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Live from New York City this morning. Good morning. Equities positive here by 1.3% on the S&P. Under surveillance this morning. Global trade disrupted.
We have rejigged our network completely, sailing everything south of the Cape of Good Hope, and expect to do that for a while until we have really safe passage reopened in the Red Sea. So this could be with us for a while. But we're also working constantly with all stakeholders to try to shorten this crisis as much as possible and get back to normal trading route.
Here's the latest. Red Sea tensions and a drought in the Panama Canal disrupting global trade as President Biden steps up U.S. port security. The White House implementing cybersecurity requirements for port owners, with officials saying over 200 ship-to-shore Chinese cranes can be serviced and programmed remotely. Port of LA Executive Director Gene Soroka saying his team is ready to work with the Biden administration on this effort after establishing cybersecurity operations back in 2014. Gene, I'm pleased to say, joins us around the table here in New York. Gene, it's always great to catch up. Good to see you.
Good morning, John.
Let's get to the big question of the day. Are Chinese cranes spying on us?
They're collecting data. They're looking at information. 53% of the Port of Los Angeles businesses trade with China. What they're using that data for is the question.
Yeah, that's basically a yes then. This is what Ann Neuberger, the U.S. Deputy National Security Advisor for Cyber, had to say about it in the Wall Street Journal report. We felt there was a real strategic risk here, these cranes, because they are essentially moving the large-scale containers in and out of port. If they were encrypted in a criminal attack or rented or operated by an adversary, that could have real impact on our economy's movement of goods and our military's movement of goods through those ports. The U.S. ports use 80% of these cranes owned by China. This is a massive risk.
It is a risk, but Anne-Marie, who else makes the cranes? And that was the emphasis and part of this discussion that the NSC, DHS, as well as the Coast Guard had with the media the other night, and further onward discussion is taking place today. How can we create that industry here in the United States to build these big shoreside cranes that are 175 to 200 feet tall, managing these large ships that come into our nation's ports?
Have you been made aware of any wrongdoing, though, that has actually gone on, or is this just at this moment a concern?
This is a great watch out for all of us in the port industry. At the Port of Los Angeles, we implemented the nation's first cybersecurity operations center with the help of DHS back in 2014. Last year, that cybersecurity operations center, or CSOC as we call it, stopped nearly 750 million cyber intrusion attempts at the Port of LA. We then created the Cyber Resilience Center, bringing in nearly 24 private sector entities, partnered with IBM, and that's stopping now intrusion attempts at the private sector level that folks weren't aware of.
This is a crazy busy time for your port. So we've got ships rerouted around the Red Sea, away from the Red Sea. We've got low water levels in the Panama Canal. What kind of capacity are you running at? What percentage of capacity are you at right now?
Right now, John, we're between 75 and 80% capacity. January was a big month, up about 18% from last year. Combination of a number of things. Long-term labor deal in place with our dock workers, confidence returning to the marketplace, and a 4 percentage point jump in market share. I was over in India and Southeast Asia last month, and what customers were telling me was subtly they're starting to move a little bit more of their cargo away from traditional routes, going through either the Suez or Panama, and targeting that towards the west coast of the United States, specifically Los Angeles.
This is what I want to get to. How much of this increased business is down to just an increase in underlying activity because business, economic growth is doing okay, and how much of it is just rerouted from other places?
It's a combination of all three. Again, stability in the market, rerouting of cargo, and we've had 6 consecutive months of cargo growth at the Port of Los Angeles. There continues to be stocking and distribution through fulfillment centers of goods that the American consumer is buying.
How much is the activity being rerouted, not only from the Suez Canal and the Panama Canal and some of these other hotspots, but also from the East Coast because of concerns about a labor shortage or a labor strike that's going to disrupt some of the activity there?
All of it, Lisa, kind of anecdotal right now and off one-on-one conversations we've had. What I don't see yet are traditional vessels in those other routes being pointed at the direction of Los Angeles. So it would be akin to going to the airport and instead of flying over London to get to Mumbai, you're going over Singapore and coming the other way. That's basically what it looks like. More folks are booking on our traditional services coming to LA across the Pacific, and those other services, as our friend Vincent Clerk said, are rerouting around the Cape of Good Hope, adding more vessels into the existing strings to make up for that weekly transit need.
To tie these ideas together, the idea of Chinese cranes and the idea that they're not being made in the U.S. and trade picking back up even if people have to reroute boats, is the whole concept of nearshoring a fiction? And is what you're seeing right now essentially that we have the same economy that we used to, where things are manufactured outside of the U.S. and brought in, maybe through different ports of entry, but ultimately from the same places?
Yeah, what we're seeing, Lisa, in these conversations with companies are that it's front of mind every day. And in our industry, whether it was building containers, the chassis or trailer wheels that haul the cargo, or the cargo handling equipment and shoreside cranes, many folks from Washington to the manufacturing community are asking, how can we take over that manufacturing process, at least on a percentage basis, and bring it a little bit closer to home?
Gene, you talked about the Labour contract on the West Coast. I remember talking to Marty Walsh every month about it when he was in the administration. That's in your past. It might be in the East Coast future. What are the lessons from your experience, and what are you expecting to take place in the year to come on the East Coast?
Well, interestingly enough, I was texting with Acting Labor Secretary Julie Su last night. She's going to be in Los Angeles for an LA Chamber of Commerce meeting this Saturday, where we'll visit. The East Coast folks have their contract coming up this summertime for expiry, but please remember, they haven't gone on strike since the mid-1970s. Now, there are big issues. These workers have to be paid. The companies must be resilient to bring more cargo in, and there are specificity around automation or robotics that have to be addressed. It's a big issue, and you'll see some folks get a little bit nervous and shift their cargo away, just like we witnessed.
Did you see the forces that led to that? Did you see that as just a moment in time or a new regime? How did you view that Labour contract?
Well, I think it was part and parcel of an entire labor movement across the country. It was the school district, the actors and writers, the UAW in Detroit and the upper Midwest, and now what we're seeing in our transportation industry, the UPS contract with Teamsters, right? Folks worked through the pandemic with no regard for health and safety. They were out there trying to keep this American economy moving. Record profits in our industry, got to pay these folks what they're worth.
What was notable about the contract in LA, the ports there, is that it was a 6-year contract. Most notably, these are 4-year deals, right? Do you expect that going forward, that we can potentially make these contracts longer?
And Marie, it all depends. Traditionally, in our PMA ILWU contract on the West Coast, they had been 6 years in duration. But of more recent times, we saw protracted negotiations getting us a little bit off calendar, and then some extensions in the last presidential administration in Washington, because there was some trepidation about how that group would react to the labor movement. So it's kind of all over the board, but getting back on a more normal calendar would be great for the industry, the workforce, and companies.
Busiest January, second busiest January on record, am I right?
That's right.
Amazing, just amazing numbers. Gene, it's good to catch up.
Great seeing you all.
Thank you, sir. Gene Soroka, Port of LA Executive Director, and I think he said that they're kind of spying on us, but not really spying on us because we don't know what they're doing.
He danced around it, but it sounded like a yes to me, just in a lot of words.
Just a slight yes. My
Data
words.
collection,
not
spying.
his words, kind of.
Everyone's spying on us. I mean, this is sort of, who isn't spying on us?
AT&T isn't.
AT&T
Not this morning.
Not this morning. They're not. But it's sort of, you can call it spying, or you can call it data collection. You can call it whatever you want. The question is, what do you do with it? And what are they going to do with it at a time where trade's really at the forefront of a lot of tensions?
Gene, it's good to see you. Always is. Thank you, sir. Coming up tomorrow morning, we'll be catching up with Mohammed Al-Erin of Bloomberg Opinion, Queen's College, Cambridge, Peter Cheer of Academy Securities, RBC's Amy Wood-Silverman, and Jay Pilosky of TPW Advisory. All of that and a whole lot more. Let's touch base on the price action going into the opening bell, 34 minutes away. Equity futures on the S&P 500, positive by 1.35% on the S&P. NVIDIA check if we can, just briefly. There we are. Off session highs, up a mere 12%. Just 12%, Bramo.
Yeah, well,
NVIDIA this morning.
It's going to be what, just $200 billion of market cap?
Just amazing, isn't it? Going to see a big market cap move in about 34 minutes' time. Live from New York City. We'll catch up with you tomorrow. Thanks for being with us. This was Bloomberg Surveillance.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
So I want a bank that shows me what I spend instantly. We're Monzo. Give us a go.
See? Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
History to put some competitive pressure back on NVIDIA.
The competition has never been more fierce than it is right now for NVIDIA, but they have a huge head start.
This tidal wave of spend, it's coming to the rest of tech. And in our opinion, that's going to continue to fuel this tech bull market.
The equity market's sort of really nicely sort of set up from here.
This AI party, it's just getting started.
Well, let's continue the AI party. Joining us now for more on this is Bloomberg's Alex Webb. Alex.
From the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did the all in one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Yes, good afternoon, Danny. I think that we are, we're quite in line with this. Yesterday's results were quite honestly, they're quite awe-inspiring, and you can't deny the impact that it's having across not just the US market and the US tech sector, but actually globally. And I think one of those reasons is that people are really buying into this idea that it isn't a tipping point, that there are going to be significant benefits, not just to those companies, but across other sectors which maybe yet haven't seen kind of the jumping on the piggyback bandwagon that is AI at the moment.
Daryl, is this the tipping point, or are you tired about talking about NVIDIA?
Well, not yet, Danny. Good morning. And I do think it's really fueling, it's not just the earnings and sales beat of the company and just the eye-popping results, but it's the sentiment it's creating, right? It's fueling this kind of fear of missing out for the investor that we are at this tipping point and that things are going to keep moving higher and higher regardless of valuations and regardless of what's prudent to pay, for the next dollar's worth of earnings. So I do think it's spilling out. I would welcome the spill out, quite frankly, because what we really want to see out of this market to make the rally both durable and these new all-time highs sustainable is a widening of breadth, right? That was absent in 2023. And so if we can get maybe NVIDIA as a lever to help us widen out that breadth into other industries, things like industrials, things like materials, places where there's tech plus. I mean, semiconductors, I just went and looked this morning, semiconductors, not just tech, we always talk about infotech and the Mag 7 and the percentage of the index, but semiconductors have gone from 2% a decade ago to 10% of the S&P 500. That's just parabolic growth of that industry or sub-industry.
But Daryl, in the meantime, while we're waiting for this market to broaden out, I've talked to a lot of investors who say NVIDIA looks like such a great company. All these AI names, like Super Microcomputer, those types of companies, they look like great names, but they have rallied so much. I am scared to get in it now that I will be left holding the bag. I am too late. What would you say to investors? Are they too late if they're not already in?
Well, we do think valuations in that space are stretched here, and history teaches you often that reversion to the mean happens. So I guess I would wait for, if I'm not in them, if I don't have kind of a full portfolio allocation, I would wait to be an active buyer here, because I do think you will see a pullback at some point. We know that when you start pushing the S&P broadly to 22 times earnings, which is where we are today, that's in the 90 to 95th percentile of where it's traded historically. And when that happens, history teaches you the 12-month forward returns are about 0% return. So history's not on your side to chase from here. I think you'd want to be a little more disciplined and wait for a better opportunity, Danny.
Well, Seema, it seems like the market's not waiting this morning. We're rallying. You can see on your screen 1 1/3% for S&P futures, NASDAQ up 2%. But we are back in the land where it seems like equities don't care about higher yields. We'll get into some of the macro data in just a little bit, Seema, but are we back in the land for at least equities? Fundamentals, earnings matter more than what rates are doing.
So I think it depends which bit of the market you're looking at. So clearly, if you're looking at the Magnificent Seven, that what the Fed's doing is entirely irrelevant. But for the other parts of the market that have still been quite unloved, they do need to see those Fed cuts coming through. Now, we are quite optimistic they will come through in the second, or at least around the middle of this year, which is why we think there's going to be a broadening out of that rally. It's just that today, of course, anything from the Fed is almost irrelevant because the market is driving off the back of a lot of that sentiment, very kind of positive news that we've seen overnight.
And at the same time, Seema, you talk about this wall of cash, something that could fuel risk assets. It's $6 trillion still sitting in money market funds. It has been remarkably sticky, but my question, Seema, is how do we know when that money comes out, which way it will spread, that it'll be evenly spread? Who's to say it's not just going to continue to chase the current market leadership?
So it's a great question. It's something that we're really trying to delve deeper into. And look, it's going to be difficult to know exactly what the timing is going to be when all of that cash floods out. But I think from the investor standpoint, as you were just hearing, parts of the market are really extended. They benefited significantly last year because there was so much caution around the economic backdrop, so many question marks around what the Fed was going to do next. But at some point this year, you're going to have answers to a number of those questions. And investors should be looking at areas which have been fairly unloved, where the valuations are quite attractive and that typically have done well when the Fed is cutting rates and there is a soft economic landing, of which there are many. So actually, we are expecting to see that flood of cash go into areas such as the small cap space, the value space, other sectors that haven't enjoyed such a strong ride as we saw in 2023.
Darryl, that's not too unlike what you were saying, this idea that parts of this market are extended and the rally can broaden out. How much of that will be aided by the cash currently sitting in money market funds?
Certainly some of it, Danny. I mean, obviously, there's some of it that's waiting to come back in the market. But I don't know that I think people extrapolate this idea that $6 trillion is going to have to find a home either out on the yield curve or in equity someplace. A lot of that is bank deposits that are sitting there for cash reasons, and they've just sought out higher interest rates. I do think it's interesting when you think about the macro environment. What was a little bit under-discussed, I thought, of the Fed meeting minutes yesterday, which NVIDIA is consuming all the oxygen in the room this morning, is that the Fed is continuing to move towards slowing down quantitative tightening. And if you go back to 2022, right, the Fed's balance sheet was $9 trillion. Today, it's $7.6 trillion, so $1.5 trillion coming down. If you keep running on the same pace this year, you'll be sub-7 on the Fed's balance sheet. That's tightening, right? So the Fed, we keep talking about the Fed easing policy and lowering interest rates, but the reality is they're holding rates where they are, and they're continuing to tighten by shrinking the balance sheet in today's world. So no policy of QT right now. Everybody wants to talk about when do rate cuts start and how many rate cuts exist.
Seema, are you talking about it? Are you and the team talking about this QT question and de facto tightening, as Darryl was saying?
So I think it's something you have to talk about. You have to be considerate of it. We are expecting the Fed to stop that shrinkage of the balance sheet. I think that they have to tread very, very carefully. We know the financial strains pick up once that balance sheet shrinks too much. And it's something that, as I said, the Fed will be very cautious about. So actually, we're not too concerned at this stage in terms of that tightening mechanism, because we do think that the Fed will try to avoid any of the kind of negative repercussions that can inevitably spill out to the broader marketplace as they continue to pursue that policy.
Well, there you go, Darryl. Someone is talking about it, but maybe not worried about it. Thank you both, Seema Shah and Darryl Cronk. Stay with us, much more to discuss. But first, let's take a look at some of the stocks that are moving ahead of the opening bell. Here's Abigail Doolittle.
And not surprisingly, Danny, we've got to start out with that big one. NVIDIA shares popping by more than 10%. This, of course, on that blowout quarter, poised for the biggest gain in 9 months since that initial blowout quarter and guide last May. The company right now, the stock potentially making a greater than $200 billion market cap move on that beat and guide for triple-digit growth and on the top and bottom line. Interestingly, this is one stock that is trying to overtake the uptrend that it fell below over the last couple of days. It's going to be interesting to see how it trades as the day goes on, but it's certainly lifting the tide for other chip companies. Take a look at Supermicro Computer, also up 11%. To the downside, though, Rivian plunging down 20%. They, of course, cut their production guide for the year to about 50,000 vehicles from greater than 80,000 vehicles. They're also cutting 10% of their salaried staff. Cash of more than $7 billion. That's less than estimated. That stock plunging down about 20%, Danny.
Abby, thanks so much. Abigail Doolittle there. Coming up, the Fed is warning about cutting rates too quickly.
And in Fed policy, there are risks on both sides, and so you wouldn't want to attach a zero probability to the fact that they may need to hike if inflation moves up.
We're going to get deeper into it. The reaction to yesterday's Fed minutes next. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long skinny necks. So Apatosaurus is an example. They also had really long skinny tails. So I made a computer model that showed that in fact the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Why do the biggest names in business choose Bloomberg?
That is a great question. It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
And in Fed policy, there are risks on both sides, and so you wouldn't want to attach a zero probability to the fact that they may need to hike if inflation moves up, which they don't expect, and we don't expect. But yeah, they think they're done, and they probably are done.
Done tightening, but are they close to cutting? The Fed minutes revealing most officials are more worried about cutting rates too quickly than keeping them high for too long. Then we got jobless claims, declining to the lowest level in a month, reinforcing expectations that are exactly that they won't be cutting rates anytime soon. Bloomberg's Michael McKee joins us now to break it down. Mike?
Well, Danny, there's two things to note about the jobless claims for the past week. One is that they were taken during the week that they do the February jobs survey, which could mean good news. The other is that it was also President's Day in the United States, and so the jobless offices were closed for a day in most states, and so we may not have seen a true representation. But the point is, last week before the last week before this one was at 213, still a very low number. So jobless claims are suggesting there is still ongoing strength in the labor market. But as you mentioned, the Fed not in a hurry to do anything about it. They're not going to raise rates right now. In the minutes, they said that participants judged policy rate was likely at its peak for this tightening cycle. They're not cutting rates soon either, though, because they're keeping an eye on inflation. Remember, they didn't see the CPI numbers before this meeting. Most participants noted the risks of moving too quickly to ease the stance of policy and emphasized the importance of carefully assessing incoming data and judging whether inflation is moving down sustainably. A couple did point out downside risks to the economy if they go too long, but nobody who's spoken since this meeting has suggested that the downside risks are becoming predominant. And as I mentioned, this is the CPI Supercore in the minutes and in several other members who have spoken since then's comments. They've talked about the fact that non-housing service in price inflation was expected to go down, but it went back up. last month, at least in the CPI, significantly. And so it leaves open the question of whether there needs to be more restraint put on the economy. But for right now, it doesn't seem to be that's where they're heading.
Well, it's enough to send yields to year-to-high dates. Michael, thanks very much. Bloomberg's Michael McKee. Seema Shah and Daryl Cronk are still with us. Look, Daryl, how much importance do you put on the data that we've been getting? Today, it's another strong labor figure. It was CPI and PPI. Is it a trend yet, or are these still one-offs?
No, I think this is still a one-off. I mean, the trend is certainly directionally to the downside on inflation. We brought it from 9% down to, let's call it 3% or maybe sub 3. Core is still a little too hot, and super core is still too hot. What's interesting and what we have to watch for, Danny, is if you look back over the last 10 weeks or so, gasoline futures are up about 12, 13% as higher energy prices, higher crude oil prices have filtered through. So, you know, history teaches you that when that energy starts to move up, if food prices even hang where they are, and Mike's point, which is the correct one about services, which is 70% of the economy, if that pricing pressure doesn't abate, then I do think that you could have kind of inflation oscillate here for a while, meaning, you know, it's not going to go up materially, but it's certainly not going to keep coming down to the rate it has been and get down to where the Fed wants it to be at a target rate.
Right, and that's a great advertisement for why yields and bonds will continue to be volatile too. Seema, do you see it the same way, that yes, the trend is lower, but it looks like this getting there? It's an oscillation down to that lower trend.
Yeah, I would broadly agree. I mean, like January, a lot of the data that we're looking at the moment is a January base. We need to see if this is extended into February, and so that there's no seasonality may be confusing things. But I would agree overall, you know, the thing that we're expecting is that the journey down back to 2% is going to be very rocky, volatile, and quite clearly quite frustrating as well. But from the Fed perspective, that isn't reason to hike. That's a reason just to keep rates at this level for a little bit longer, which is why the March numbers, the March expectation was seemed very optimistic to us, and why a mid-year number seems to make more sense. Now, if on the other hand, over the next month or so, you were to see another blowout jobs number, another very high CPI number, which is really driven by that non-housing services, well, then I think there is maybe some cause for concern, and the Fed will inevitably be having some discussions around, and the market will start to be maybe speculating, putting a little bit more probability onto the chances of a rate hike. But for the time being, we're sticking with that forecast that June is the first date for the rate cut.
Well, Seema, Torsten Slok from Apollo had been writing today that part of what's making it harder is the Fed themselves. He wrote that, quote, the last mile is harder, not because of some structural feature in the economy, but because of the Fed turning dovish too soon, triggering a reacceleration in growth and inflation. That is why the Fed will keep rates higher for longer than markets expect. Seema, what do you make of that? Is the Fed making the job harder for themselves, or even starting that cut talk?
It's an interesting perspective, and actually I have to agree to some extent, because back in October when Powell suddenly adopted a more dovish stance, that didn't help things. It certainly assisted in a further loosening in financial conditions. It inspired markets to rise even further. So I think there is some truth to it, and maybe there is some regret, and you certainly have seen a number of Fed speakers over the past couple of months sometimes walking back a couple of comments that had come out from Powell. But I think that, you know, over the last 18 months, we have also heard them repeatedly refer to the 1970s experience where they did cut rates too soon, and then that triggered another rise and a new peak in inflation. So I think that caution stays with them, and it probably means that they are going to be a little bit slower to hike, and I think the last month's data was probably a timely reminder for them.
They're not the only one talking about the 1970s. Daryl, Marco Klonovich over at JP Morgan was out with a note saying that it's 1970s stagflation, that we're underpricing that risk. Now, I should just be very clear, Marco has gotten some market calls very wrong over the past year, but ever the contrarian, he's out with this one. He says, look, it could be stagflation, and that means fixed income outperforms and stocks are pretty flat. What do you take of that?
I still think the bar is pretty high for stagflation. I mean, stagflation means you got to have inflation accelerate from here, or at least stay high and elevated while you get de minimis growth, right? And so what we've been talking about here lately is not economic growth rolling over and becoming problematic. It's simply, it's chugging along faster or better than expected, certainly in the U.S. That's not the case globally. I think stagflation is a conversation of what's happening in Europe right now and maybe even select parts of Asia, but I don't think it's a conversation of what's happening here. I think what people have to do is you have to define what is a soft landing. What's the Fed been trying to achieve? And a soft landing to us is supply-demand balances in the economy, balance out, inflation comes down to target, and then interest rates end up at neutral. And the question is the last one, where is neutral on R squared? People are arguing that's too, R squared is too high, or R star, excuse me, not R squared. R star is too high and needs to come down, and the Fed needs to just take a little bit of its foot off the accelerator on the tightening path to make sure the economy soft lands here.
I was about to say, Daryl, I've barely wrapped my head around where R star is. I don't have time for R squared to learn what that is. Seema.
Sorry. Yep.
Seema, I want to wrap it up here. We unfortunately have less than a minute, but I was struck by you saying that alternatives provide important diversification against traditional equities and fixed income. What should my alternatives be?
So first of all, the reason that it's important is last year, because inflation was coming down, you did see investors turn away from alternatives, the inflation protection part of it. And I think now we're remembering that inflation is by no means dead, and there's still that importance of having that protection in your portfolio. So things like infrastructure, commodities, natural resources, those are the areas that we still think deserve a place in the portfolio. Maybe it doesn't do as well if there's a significant equity market rally, but I think we have learned in the last 2 years that there's always a risk that inflation starts taking off again, particularly with the geopolitical factors coming through this year.
Right, and hopefully we learned our lesson of the last few years of what bonds can and can't do. Seema, Daryl, really appreciate your time. Seema Shah and Daryl Kronk there. Coming up, we're going to get in your morning calls, and later, why all stocks aren't created equal. We'll be speaking with BlackRock's Jean Boivin, making the case for mounting dispersion in the equity market. That conversation still ahead here on Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Get you your morning calls now. Look at some of the analyst recommendations. First up, Morgan Stanley upgrades DoorDash to overweight. They say it's an attractive valuation and there are opportunities for robust growth. Next up, Evercore downgrades Capital One to inline, saying that there's limited upside due to uncertainty around its deal for Discover. Finally, Bernstein downgrading Wendy's to market perform, saying there's overly optimistic growth estimates and limited catalysts. Equities near the highs of the day. Coming up, we'll speak with BlackRock's Jean Boivin, who says it's time to get selective. That conversation up next.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is the countdown to the open. I'm Danny Berger in for Jonathan Farrow. Moments away from the start of trading, it's the tide that lifts all boats, rather. NVIDIA helping us get to the highs of the morning. NASDAQ futures, they are at 2%. Even small caps are doing okay, up about 1/3 of 1%, but we're 1.3% thanks to what Goldman Sachs has called the most important stock in the world. HSBC, though, says NVIDIA, they won't be able to repeat it again. Maybe now's not the time to buy. Meanwhile, cross-asset oscillating back and forth between gains from the euro thanks to hot French PMI data this morning. That gets undone by strong labor market data. Means that the dollar's little change. Your 10-year yield little changed, also 4.32%. Yields touching about the highest of the year, while NYMEX crude, $77.75. The one stock everyone is watching this morning, and let's be honest, maybe tired of talking about, but we have to talk about it. NVIDIA delivering blowout results and adding roughly $250 billion in market cap this morning. That is the biggest one-day increase on record. Bloomberg's Alex Webb has more. Alex.
Yes, the numbers were quite extraordinary. Analysts and investors seem to be running out of hyperbole in how they describe NVIDIA. Of course, the numbers themselves are impressive. The forecast, which is for the quarter we're in right now, the one that will end at the end of April, that was $2 billion ahead of what the market had been anticipating, about 9%, a meaningful number. But almost more importantly than that were the comments from Jensen Huang. Because NVIDIA only forecasts 1 quarter ahead, that can create a little bit of skittishness among investors. They are not entirely sure how long this run is going to continue, whether NVIDIA can continue to beat expectations again and again. What Huang said on the call was that he expects this trajectory to continue through 2024 and into 2025. That seems to provide a huge amount of relief to investors, and is perhaps one of the reasons that we're seeing such a pop in the shares today.
Yeah, I mean, the decks were cleared earlier this week with the sell-off, so why not dive in now? Alex, thanks so much. Of course, it's a very different story for Rivian this morning. Shares getting hammered. They delivered a disappointing outlook along with a plan for another round of job cuts. Bloomberg's Abigail Doolittle has the details. Abby.
To its worst day on record, not so many years, because of course they IPO'd back in 2021, but right now down more than 80% from that IPO level on that outlook that you were talking about. They're talking about 57,000 vehicles to be produced this year versus the estimate of greater than 80,000. In addition, cash is at $7.86 billion relative to what was expected at 8.74%. That's significant given the fact that this is more of a startup developmental stage company with supply chain snarls, uncertainty for consumers is being blamed for the production cut, and the 10% cut of salaried workers. It's not just Rivian that's down, though, today. A very interesting story is developing this morning, Danny, and that, of course, is the fact that we have AT&T down on a report of wireless disruptions across the country, trending on X. Some are saying that they even had terrible service on AT&T yesterday. Outages were reported in cities including New York, Houston, Atlanta, Miami, Chicago, and Dallas. Customer service representatives for AT&T said on X that they had confirmed an active, quote-unquote, active nationwide outage. The cause is not clear, so they're working to fix it. Tough to fix it if they don't know. What's also very interesting, on Twitter, the top trending, or on X, I should say, former Twitter, Verizon, then outage. We also have nationwide. But Verizon, around 8 o'clock, said that their network is operating normally, and T-Mobile, they said something similar in the fact that, I'm just waiting for the headline to pull up, their mobile network did not have an outage, yet users seem to be experiencing something different. So this is a fluid situation. I'm sure we'll be reporting it throughout the day, but very interesting, in fact, and the stocks, for the most part, are lower.
Yeah, one of those weird days where you can be like smug for what type of phone service you have. Abby, thanks very much. She mentioned Rivian now hitting the lows, record lows, with that sell-off after the job cuts. Let's stick with earnings. Etsy results missed estimates, the company adding insult to injury, saying it's having a, quote, slow start to the first quarter. Bloomberg's Katie Greifeld has more. Hey, Katie.
Hey, Danny. Yeah, it's a familiar story at this point in earnings season. The fourth quarter actually wasn't too bad, but it's the outlook that was disappointing, and you're absolutely seeing that in the shares this morning. To get into the specifics here, fourth quarter revenue came in at $842 million. That is above the estimate of $827 million. So a beat there, but it was that guide that was pretty cautious. The company said in its shareholder letter that gross merchandise sales for the first quarter of 2024 currently estimated to decline in the low single-digit range on a year-over-year basis. The company did say that it expects that its marketplace will improve as it moves through the rest of the quarter, but it also did note that if our trends fail to improve as we currently expect, this could become a mid-single-digit decline. So there you have it, pretty cautious there. Jefferies cutting its price target, also noting that additional competition from the likes of Temu and Shein, it makes this firm less confident that actually it will improve as expected. And again, you take a look at the shares, currently down about 7% on the heels of that.
Katie, thanks very much. Katie Greifeld there. Now, finally, let's take a look at the cruise line stocks. They are up. Royal Caribbean raised its annual profit forecast. It did ease investor concerns over slowing demand. Simone Foxman's with us now. Hey, Simone.
Hey, Danny. Yeah, the last time we got an outlook from Royal Caribbean on its 2024 performance was just 3 weeks ago, February 1st. Now the company says bookings have exceeded the company's initial expectations. Right now is the time when cruise companies offer their best deals all year, what's called wave season. Royal Caribbean saying it is the best wave booking weeks in the company's history. They are seeing strong demand all 4 quarters of the year, according to this statement, especially bookings for the back half of the year, much better than they were last year. And part of this is because of some of the higher price points on these bookings that we're seeing. All of this allowing the company to boost its earnings per share projection by 40 cents for the year to $9.10 to $10.10. 15 cents of that, it says, is going to be driven by that first quarter revenue. This was allowed the company to be upgraded by Moody's, now just 2 notches below investment grade. The company's very much been trying to get back there. We've seen that concern about demand for these cruises after we saw a strong recovery last year and pretty stunning performance, 161% gain by Royal last year. But Stifel says this should put to bed any bear thesis around cruise demand or pricing weakening. We'll look at this, especially as we look ahead to Norwegian Cruise Line's earnings next week. Dan.
Simone, appreciate it. Now, let's get back to the broader equity market, because the S&P up more than 1% out of the gates, at one moment touching its highest intraday record. It's backed off of that. BlackRock's Jean Bovin commenting that investors are starting to get more selective, writing, quote, "We think market optimism can persist for now, but stay nimble. We get more active in our long-term portfolios given a greater dispersion of returns." Jean Bovin joins us now. Jean, I'm going to be honest, I look at a day like today and I'm like, okay, the dispersion is NVIDIA and AI stocks, and let's be honest, tech stocks outperforming them all. Can you be an active manager right now and be selective without just outright being overweight AI stocks?
Well, it's part of being selective right now is to be overweight the AI thematic. So this is something we've been, trying to ride for some months now since, mid last year. I think that continues to be a big, powerful driver, and we're still positive on that space for the time being. But I guess the point we're trying to make as well is that you cannot rely on this to just be a bull, the prelude for a 10-year bull market. So this is going to be a choppy environment eventually, and you need to be ready to pivot at some point. And this week was a testimony to this, right? You got the big tech story playing out, but at the same time, lo and behold, we got a big, significant repricing of Fed expectation that has been happening over the last 6 weeks. We now have only 4 cuts being priced in now. The 10-year is moving up, as you were mentioning before. So, there's cross current going on. For now, we think, though, the constructive backdrop is pretty solid, and it's across the board.
Yeah, Jean, I have to say, I spoke with your boss, Larry Fink, about a year ago, and he was talking about AI then. I mean, the world was talking about AI then, but it's fair the Research Institute at BlackRock has been writing about the AI theme for a while. And I get a lot of commentary from fund managers who say, I missed the boat. I didn't invest in NVIDIA a couple years ago. It's gained some 200-something%. If you're not already in the AI stock, Jean, am I too late?
I think the AI story, we call that a mega force. So I think this is something that's going to be playing out for the years to come. It's not about just getting in right now. Now, it's going to be evolving. It's not necessarily about 1 or 2 companies. It's about how this now moves to the implementation phase. It's about the healthcare sector that's going to be benefiting from massive implementations from AI. That's for us, like on the horizon, and then it's going to morph into other things over time. So the AI thematic, I think, is a mega force. It's going to be, playing out over the many years to come. Now, it won't be about 1 or 2 stocks for forever. So I think for us, that's what being selective is about. It's about figuring out what the next phase of this AI knock-on effect.
Good, because I think we're tired about talking about Mag 7, then Mag 6, then, I don't know, Mag 1, I guess is where we are now, Jean. Look, it has been a really resilient equity market, but you're talking about this idea that at some point it will turn. It won't be a market that you can just buy the entire thing. What is that turning point? What prompts that breaks some of the widespread resiliency of this equity market?
Yeah, so one of the key theme we have for 2024 is that you need to manage macro risk. It's not an environment where the macro backdrop is going to be your friend and, basically be a tailwind that you can count on over time. We think this is going to be a much more tricky macro environment. Right now, the dominant story is really about hopes of a soft landing. It's about the Fed that's going to be actually cutting rates. I think we're getting close to that point. The next phase later this year will be, I think, a bit more complicated, where we're going to see that even though inflation, in our view, is going to go to 2 and is going to tap 2, it's going to be temporary, and then we're going to see a rebound in inflation later in the year. So to us, like, one of the big signposts to watch out for is how the inflation narrative change. And it's not about sticky inflation staying now above 2. So this is what the way the Fed is. That's what the Fed is worried. I think they're going to be comforted in the fact that inflation actually is going to 2. We're going to see things that look like 2%, but it will be temporary. And so and it's later. So for now, we think it's going to take some time before this strong constructive narrative gets disrupted. So there's no point leaning against that. You want to ride that.
So if we see 2 prints around 2, Jean, and it's kind of a head fake, are you gearing up for Fed hikes down the road then when we get inflation resurging?
I don't think it's about Fed hikes. I think it's about, market was expecting more than 6 cuts. Now there are 4. We might get 2 or 3 in the end. So it's about less Fed cuts. It's about a shallow, very muted easing cycle, combined with inflation that surprised on the upside, and that's going to be a bit different. And just the fact that the markets have been pricing out 2 cuts this year so far. We've seen the 10-year starting to move back up to 4.3. So imagine in a world where now we see a bit of inflation rebound, and the 10-year is on average higher than it is right now. is going to change a bit the lens by which we're looking at risk assets later in the year.
And Jean, I mean, we learned this. We learned that bonds are bad at protecting against equity losses when the reason for those losses is inflation. If you're saying early 2025 or after this year, we are going to face that threat of inflation coming back up, what serves as my protection in my portfolio? What have I learned over the past few years that's going to help me this time around?
Well, I think one thing this is the opposite of your question, but I think we want to be careful to extrapolate lessons from the many years, the last 20 years, because they were a very peculiar 20-year period where, you know, we've learned lesson like you expect bonds to play the ballast role in the portfolio. And this is not something you should necessarily count on as easily in this environment where if we do get some market adjustment, risk asset sell-off on the back of inflation being surprising somewhat on the upside, I mean, nothing like huge inflation, but surprising on the upside, bonds will not be providing as much of a ballast in this environment. And this is where I think you have to fall back on a more nimble, you know, active management of your asset allocation. That's going to be really the only way to navigate that.
Jean, less than a minute here, but you like Japanese equities. They hit a new record high today. How do they keep going? What powers them further?
So, you know, I think this is again, one of the high conviction view we have. This is one place where the macro is your friend. You know, I think there's a pretty constructive backdrop with inflation there being a positive, continues to be, where the BOJ is, in fact, I think, approaching things in a very relaxed, reasonable way, not panicking on inflation. And I think so that is certainly a big part of the story. But like, it's also important to know that, you know, it is a big yen story when you look at the performance of Japanese equities. But once you take that into account, well, if you look like in a common currency, there has been like a good story in Japanese equities, but it still is not like back to, it's still lagging. U.S. or, you could debate about what relative to Europe.
Right.
But the point here is I think this has more room to run. And in fact, it's really more about the macro going forward and the corporate reforms that are starting to get traction. And we think will carry support for equities, throughout this year.
John, really appreciate your thoughts this morning. That's Jean Bovin of BlackRock. Coming up on the program, Capital One is facing pushback from Capitol Hill.
The pressure to scrutinize it, I think, is very intense. Certainly to draw out the review, I see no reason to think this is going to go through quickly. How it goes in courts is a different question.
Are you really surprised? We'll have the details on Capital One's deal with Discover next. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Do you see a future for Monumental as a public company?
Yeah, I think so. I think what we found is the leagues have opened up to new pools of capital. Over the last year or two, both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that, if that time was there, sure, we could go public.
So the pressure to scrutinize it, I think, is very intense. Certainly to draw out the review, I see no reason to think this is going to go through quickly. How it goes in courts is a different question. I think the kind of pro-competitive impact of strengthening Discover as a competitor to Visa and MasterCard is going to be more compelling when it actually goes to litigation, if it does.
Capital One's Discover deal is facing resistance on Capitol Hill. Lawmakers are pushing back on the $35 billion takeover. Senator Hawley, following Senator Elizabeth Warren's lead, taking to social media and writing, quote, "Sounds like the credit card companies are finding another way to screw the American people. This merger should be blocked, and Congress ought to cap credit card rates pronto." Let's now get into this with Bloomberg's Anne-Marie Hordern. So, Anne-Marie, it's not just Senator Warren. It's coming from the other side, too.
It's not. And sometimes in politics, you see interesting people make friendships look across the aisle. You would normally never talk about Senator Warren and Senator Hawley being in the same camp. But when it comes to Capital One and Discover, both of them think that this deal is not good for the American consumer. You heard from Senator Hawley there saying that some of these credit card companies, the rate should be capped. But really what it comes down to is what's the DOJ and the FTC going to do? And what we know from this DOJ and FTC is that they don't really like mega mergers. We've seen that in a number of instances. Most recently, our reporting is that the FTC is prepared to also sue to block the latest Kroger-Albertson deal. So if that can't get through, you have to think it's going to be very challenging for Capital One and Discover to get their deal through, especially on the heels of a 2023 where the Biden administration set a record for breaking up some of these mergers.
Yeah, Anne-Marie, I know literally the first question you asked when this happened was, are regulators, is Congress really going to let this get through? So again, is anyone really surprised with this? Anne-Marie Hordern, thank you so much. Now, we had data crossing the terminal just moments ago. It's U.S. PMIs. Bloomberg's Michael McKee joins us with the details. Hey, Mike, what you looking at?
Well, we're looking at an economy that's still going reasonably well. A little bit of a decline in the S&P Global PMIs for the U.S., but not much. Still in expansion territory, 51.5 for manufacturing. That's good news because it's up a little bit from the 50.7 that we saw the prior month, and manufacturing has been the question mark. Services down a little, 51.3 from 52.5, and the U.S. composite comes in at 51.4 from 52. Nothing to worry about there. Of course, next week we get the ISMs, which matter more to U.S. markets. But in Europe, they care about the PMIs, and it is still a down economy pretty much across the continent. The French and Germans, a lot of 40s there. The Eurozone itself gets a 50 for services, but manufacturing is still depressed. And Danny, just to make you homesick, the UK, a little bit better in services, 54.3, but manufacturing still taking the pipe, as they say.
I don't know if that makes me homesick, because it makes me think maybe it's good that I'm not there. If the economy looks like that in services means maybe there's still inflation. So yeah, Mike, I'm happy to be here in the U.S.
Happy to have you.
Michael McKee, thanks so much. All right, that's the data this morning. Let's look at some of the sector price action and go over to Bloomberg's Abigail Doolittle. Hey, Abby.
Hey, Danny. So not surprisingly, we are seeing very bullish sector composition for the S&P 500 right now, up 1.6%, heading to its best day of the year since November of last year. Not surprisingly, tech, that's the big sector on that NVIDIA blowout quarter and guide, with that stock hitting a new record high, up 3.9%, its best day since May right. Now you can see the other mega cap tech sectors are also higher, including communication services. But if we dig in a little bit more there, we actually have some declines for the likes of T-Mobile, AT&T, and Verizon. This, of course, on the report of AT&T wireless disruptions across the country. They're happening in New York, Houston, Atlanta, Miami, Chicago, and Dallas. Some of the customer service representatives for AT&T on X said that they had confirmed that there's a quote-unquote active nationwide outage. Now, there are people on X talking about Verizon and T-Mobile problems, but representatives from those companies are saying that there isn't an outage, that there is not a disruption. So it's going to be interesting to see how this story evolves as the day goes on, Danny.
Yeah, it certainly does. I saw even the San Francisco Fire Department tweeting out saying, hey, you can still call 911. Maybe just find a landline somewhere. Abby, thanks so much. Abigail Doolittle. Coming up, we're going to look at the market-moving events you need to watch this week and next. That's up in our trading diary here on Bloomberg.
Hardest thing in life, I've often said, is to be happy.
Paul from the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurize the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Of retail earnings. That includes Macy's, Lowe's, and eBay. Maybe then we'll stop talking about NVIDIA earnings. Until then, that's the countdown to the open. This is Bloomberg.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for bingo.
We can do that.
But There goes my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. Your fixed income fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele is out this week on holiday, but sitting in for Alex today. What a treat. Emily Gaffeo, Bloomberg News. She covers the markets for all Bloomberg News, so she's going to hang out with us for the next couple hours. So that's a good thing. Looking at the markets, lots of green on the screen. Why? Because NVIDIA, the bellwether of this tech space, of this market, had just a blowout print last night. And we're going to break that down with Kujan Sobhani. He's Bloomberg Intelligence. He's the tech analyst that follows this name, so he'll break it down for us. And then a treat, Gene Soroka. He's the executive director of the Port of Los Angeles. He's been instrumental to us over the last 3 to 4 years, walking us through supply chain issues that really came to bear during the pandemic. He runs the Port of LA. He knows what's happening. He's going to give us the latest there. So that's all coming up. Sam Fazeli as well. Holy cow. Talk about a killer lineup in the first hour. Bloomberg Intelligence. He's our pharmaceutical analyst over there in Europe. He runs the whole European operation for Bloomberg Intelligence. He's going to join via phone. So we got a lot happening here. And we're going to kick it off with John Tucker.
All right, we are data dependent, Paul, so let's start off with the data. Existing home sales, we can call them used home sales, coming in at a 4 million annual rate. The expectation was for 3.97 million. Now, earlier today, we saw applications for unemployment benefits falling to the lowest level in a month last week, and that underscores continued strength in the labor market. As a result of that, looking at the two-year yield, which is more policy reactive, that's up 2 basis points. That's at 468. In the driver's seat, of course, NVIDIA, chipmaker delivering another eye-popping sales forecast. Dan Ives at Wedbush Securities had this reaction to NVIDIA earnings.
And this was a game-changing quarter. It shows that this is not peaking, it's accelerating. This is jet fuel into the broader tech rally for Microsoft, for chip names, for what I view as probably the most important earnings we've seen in 5 years.
Right now, the S&P 500, 80 points higher. That's up 1.61%, blowing through the record, 5,061. The Dow also at a record, 371 points higher right now. That's up 1% at 38,983. The NASDAQ 100 is up 395 points. That's a rise of 2.25%, 17,870 on the index. And we should tell you this market drivers report being brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit IBKR.com. And that is your Bloomberg Business Flash. We check the markets every 15 minutes right here on Bloomberg Radio. I'm John Tucker. Emily and Paul.
All right, John Tucker, thank you so much. We appreciate that. Emily Garfeo sitting in for Alex Steele. Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. Also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. That's the best way to get it. It gives you lots of options, and you can find the radio when you just click on that. That's the easiest way to get there, I found. We're also in your dashboard with Bloomberg. So we got the app there, and you get the Apple Autoplay and Android Radio. So anywhere, any technology, that's where you find us here. Again, as John was just reporting, a super strong open to the market here, driven in large part by the huge print we got from AI player NVIDIA last night. Let's check in with Norma Linda. She covers all the markets for Bloomberg News. She joins us here in our studio on 58th Street here in Manhattan. Nora, what are you looking at?
Well, it feels like we just can't get enough of NVIDIA this morning. That is another blowout earnings report from the company. We saw revenue in the current period will be about $24 billion. Analysts have predicted $21.9 billion on average. And so the market cap has actually increased by more than $650 billion this year, bringing the company's valuation to $1.89 trillion.
I'll round up to two.
Let's round up to two.
Yep.
But it feels like analysts really cannot run out of hyperbole to describe the company in this blowout beat. But as we do know that this company does cater to companies like Amazon, Meta, Microsoft, Alphabet, so this really has been a key player this year.
Yep, absolutely. And we're going to get a lot smarter on this with Kunjan Sobhani. He's a Bloomberg Intelligence senior semiconductor analyst. He's coming up in just moments. He covers the stock for BI.
Let's take a look at Rivian. On the flip side, we're down here, plunging as much as 26%. That's the worst day and lowest level for this company on record here in the intraday. And as we know, this company IPO'd just back in 2021, and it's down about 80% from that IPO. So really a plunge there. And the company said that it expects to build just 57,000 vehicles this year, which we know is well short of the analyst's average estimate for more than 80,000 units.
Nora, what about AT&T this morning? Because I've been speaking to a few coworkers that use AT&T, and they have been struggling this morning.
Really? Okay.
They've not been able to place calls or text messages.
It feels like a war. It feels like we're all battling for who has the best phone plan, which company we're with. But we are seeing AT&T shares pairing a bit, but they were slumping as much as 3.4%. And this is coming after a lot of reports of widespread disruptions to its mobile service across the U.S. We're hearing both Verizon and I know T-Mobile coming in via Twitter, or I guess we should call it X now, saying that other people are having disruptions. They're saying that things are cool. So it's a bit of fluctuation here. It's a bit of a fluid report, but I mean, my phone's okay. How are yours? Who are you with?
I'm a Verizon.
I'm a Verizon.
I'm with Verizon.
There you
I'm
go.
good.
Some unity here.
I mean, Paul's the telecom expert. What do you make of
it's
this?
interesting. I'm not sure. Maybe we'll grab John Buller, who covers this sector for Bloomberg Intelligence, get a couple minutes with him. Its question is it seems like it's kind of primarily localized to AT&T and their network per se. And when you see a network problem, I kind of feel like that's something they can fix from a network node somewhere. So I'd be surprised if this goes on, very much longer. But again, if you're AT&T, this is kind of operationally kind of your worst nightmare type of situation.
Of course, and apparently they can't really get to the root of what the issue is. They're trying to figure out where this is all stemming from. And so it's kind of, where do we even begin to try to fix this outage? But that's not what you want to hear and not what customers want to experience.
All right, AT&T, or as we called it back in the day, telephone. I'm buying some telephone here, AT&T. It's down about 1.9% here on the day on the news. Norma, Linda, thanks so much for joining us here. The story that does not have any issues with its network is NVIDIA. Again, posted a big print last night, as Nora was just reporting. And everybody was focused on the revenue guidance, and they did not disappoint there, given a revenue guidance that was substantially above where the street was yet again. And that's kind of all the bulls needed here. Emily, let's bring in Kunjan Sobhani. He's a senior analyst. He covers the semiconductors for Bloomberg Intelligence. He joins us via Zoom. He's in San Francisco. Kunjan, you're the grizzled veteran. You've seen these semiconductor companies come and go. What'd you make of NVIDIA last night?
Yeah, I mean, look, any earnings surprise from NVIDIA is no longer a surprise. We have come to sort of expect this to be a new norm. But there were a lot of positive, reassuring things. On the supply side, we saw supply coming up really strong. More importantly, supply getting diversified, and the benefits for which were seen in their gross margin, which beat the estimates. But more important was the assurance that demand continues to stay strong, and they expect it to stay strong in 2024. And not just from the large cloud players, we all are aware of how much money they're spending, but demand strength was broad-based across their enterprise customers, across the different verticals. So that really reassures us for the 2024.
What did you make of the CEO's statement that generative AI has hit the tipping point? I saw that headline, and I didn't actually really understand what that meant. So what did you think of that?
I mean, look, it's really Jensen. If you have been following the company for the past 10 years, at every junction, that's what his messaging always is in whatever they're working on. So, but apart from that, I would really, ask investors to look into the end data points rather than what just he is saying. I mean, he's a very important person right now, but we look at the end data points. The customers are really increasing their AI spend, right? The IT total CapEx budgets are increasing, but the AI portion within that is also increasing. And it's not just at the chip level. The contracts that they have with their software customers, even those customers are guiding up their revenue targets.
Hey, Kunjan, I love their customer list that they read off. It's kind of a who's who of Silicon Valley, Facebook, Google, whatever their new names are. What's the next, is there a next set of customers out there above and beyond kind of the household names that we all know that maybe they're targeting?
Yes, an enterprise segment is sort of the next area that they're really targeting, right? They already have the big, large spenders, but now they want to diversify and expand their reach across enterprises. And the second big target now is sort of governments and sovereign governments and sovereign wealth, right? That's what they're targeting, that they believe AI will be, because of geopolitical and trade issues, will be more regional, and every big economy will need to spend on that.
Are there any headwinds that investors need to be looking out for? Because I just looked on the ANR function on Bloomberg, and there are 0 sells for NVIDIA. There was one last night from Morningstar, and now he's upgraded to a hold.
Yeah, I mean, look, if you look at just what the data says, usually the stock price follows the analyst price targets. It seems here the price targets are following the stock price. When we look at the fundamentals, right, there was really nothing that to highlight as a risk factor in the earnings and really in the near term for 2024. But if we were to form a bear thesis, a couple of things that we would look at as risk factors for the long term. One is the China risk. We did see China revenue almost reduced by half versus 3Q in this quarter, right? And we know this problem is not going away, if at all getting worse. So right now they are easily able to offset what they could have shipped to China while shipping to other customers in US and other regions. But at some point, when the demand supply sort of normalizes and the growth rates become more of a normal run rate, this is taking out a bite out of that opportunity that they could have served in China. So that's one risk factor on the long term. The second being their largest customers, which are the cloud players, have started to design their own chips. So again, this is far out, but at some point, this still takes a bite out of the apple that NVIDIA could have served.
So that's kind of where I wanted to go, Kunjan. I mean, just the competitive environment, can you explain why these guys are the only game in town. That seems odd to me.
I mean, it's not by an accident. These guys were sort of the inventor, if you will, for the GPU. They have been working on a GPU for decades and out investing everyone, being at the leading edge. So, you know, this was the same question when we talked about gaming and when we talked about crypto, right? The last two waves which drove the growth for this company. It was not by accident. They have been at this forefront of these new applications where the application suddenly realized, well, GPU is the best case compute platform, and that's why they adopted GPU. Same thing what we're seeing with AI. So this was not by accident. If you look at their R&D spend, which they guided to be growing by mid-30s next year, that's a significant amount of R&D dollars they continue to spend and to keep, again, being at the leading edge of the next cycle of innovation.
Can you talk a little bit also about the gaming revenue here? Because I'm looking at your report. You said gaming's better than seasonal top line, but what was really driving that? Because I actually don't really know if I know anything about NVIDIA's gaming involvement.
Yeah, so the last quarter was, if you look at typical seasonality, we expected it to be a down quarter, at least by mid-single digits, but it came in flat, right? So, and the strength, the driver for that was better demand for their RTX products. These are their gaming cards, you know, in desktops and what gamers get. So this is what came in better than they had expected due to the holiday season. Now, this is, again, a temporary move and sort of no longer a big focus for investors, but that was still good to see that in a typical down seasonal quarters, they were still able to do better than seasonality.
Kunjan, talk to me. You're investment research analyst. You care about valuation. It's not just all hype for you. Give us a sense of how this stock is valued. God, it's up a gajillion to 1%. Don't we have like concerns about value here?
Yeah, we do, just like any other stock which has a premium valuation, we do. One thing that gives us a little bit comfort now, like when you look at the valuation multiples now versus, let's say, 6 months ago, they have come down to a sort of, now it's a reasonable premium above stocks and in sort of in line or slightly better than its peers. And look, it is still the fastest growing story in semis. It is, at this size, it is still the de facto name when it comes to AI. As of today, it is taking almost entire wallet share of AI spending. So if you, it does deserve that premium.
We're about to speak to the executive director of the Port of Los Angeles. Yep. In just a few minutes, Gene Soroka. So I imagine we're going to be talking about the supply chain. Could you give us a sense of how NVIDIA is dealing with the snarled global supply chain? Any challenges there?
They have done an absolutely amazing job at bringing up supply, right? The last year, for every quarter, the biggest concern was not demand, but supply, because usually when you try to bring up supply so fast, so quick, you do run into hiccups. We didn't see any hiccups throughout every quarter last year. In fact, you know, the gross margin upside, a key driver for that was lower component cost. And what we did from that is that they were able to get more suppliers online. They were able to expand and diversify supply and enjoyed the benefits of the pricing that comes with it. So they've done an absolute amazing job bringing up supply this quick.
All right, so in the chip space, the play here for AI is NVIDIA. Is there a number 2 play that I can try to, you know, jump onto?
I cannot comment regarding the valuation, but from the fundamental point of view, a couple of other names we really like in terms of AI in semis are AMD and Broadcom, and to some extent Marvell.
All right, Kunjan, thanks so much for joining us. Kunjan Sobhani, senior analyst on semiconductors for Bloomberg Intelligence. He joins us on Zoom from San Francisco. And again, just a great print out of NVIDIA, and that's something that the stock had to have because it's up over 240% over the last year, and it's up, you know, 50% year to date. So that was a high bar of expectations for the street, and the stock's up 15% on the print. So market's telling you they liked what they heard last night.
Yep, biggest intraday gain since May 25th of 2023, now up to $776 per share for NVIDIA.
And for a market cap of $1.94 trillion, so some significant market cap, and that's kind of lifting the markets across the board here today. The S&P up 1.5%, the Dow up 0.7%, but the Nasdaq and the Nasdaq 100, those are the tech-heavy indexes and that most closely track the technology space, up about 2.4% today. So a big move there in the markets. And I know the VIX for Tom Keene, it is off sharply, down just above 14 here. So this is a market, Emily, like a lot of folks were saying, tech has been a leader of this market for so long. And certainly just for 2023, after the dismal 2022, it really reasserted its leadership position in 23. It looks like it's going to continue that this year.
Yeah, exactly. I talked to a lot of portfolio managers who say you really just can't bet against tech. And it's interesting, too, because we are seeing treasury yields higher just by a little bit. The 2-year up almost 3 basis points. And the market, at least the equity market, just doesn't seem to be bothered by that.
Nope, not at all. So again, the 10-year treasury, as Emily was saying, 4.3% on your 10-year. Looking at the commodity space here, just a little bit of check there. We've kind of forgotten about that today. WTI crude oil pretty much unchanged on the day, sitting right around $78 per barrel. Gold a little bit lower, $2,020 an ounce. And Bitcoin off just slightly today, but still 51,300 for our favorite cryptocurrencies. They are holding on to some gains there as we get the spot ETFs taking in more and more money. We'll have more coming up. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got the Dow, the S&P, NASDAQ 100 index, and the Russell 2000 all pushing higher. We begin with the outperformer, NASDAQ 100 index, tech stocks in specific. Right now we have got NASDAQ pushing higher by 2.3%. The NASDAQ 100 index also up 2.3%. S&P 500 index is advancing 1.5%, back above 5,058 on NASDAQ. Year to date, by the way, the S&P up now by 6%. The Dow up 271, up 0.7%. We've got the Russell 2000 up 0.4%. NVIDIA, of course, the big story today. NVIDIA shares now surging by 15.2%, just about at the best level of the day. NVIDIA is on track to beat Meta Platforms' historic stock market session just 3 weeks after the Facebook owner set the record. Also, Synopsys shares are surging after the maker of electronic design automation software reported first quarter results that beat expectations. Today we're looking at Synopsys up now by 10.8%. But obviously NVIDIA, the big stock market story today, of 15%. Going to be talking about this all day long. 10-year yield 4.31% with a 2-year 4.69%. We've got spot gold lower by $5 the ounce to 2020, down just about 0.3%, while West Texas Intermediate crude oil now up 0.2%, 78.11 for a barrel of WTI. So again, recapping here, stocks are rallying. S&P up 76 now, up 1.5%. NVIDIA, worth repeating, up now by 14.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate it. Emily Grafeo sitting in for Alex Steele. Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to YouTube. You can search Bloomberg Podcast, and that'll get you right to the place you need to be to find the live radio feed. So it's good stuff there. You know, during the pandemic, Emily, one of the economic issues that really became apparent is supply chains.
Oh, yeah.
And how, susceptible supply chains are to disruptions. And boy, shutting down the world's economy and then reopening it creates some disruptions. And one of the people we leaned on for kind of analysis and explanations about how this whole thing works is Gene Soroka. He is the executive director of the Port of Los Angeles. Yes, that port, the Port of Los Angeles, is one of the world's busiest seaports and a leading gateway for international trade in North America. So Gene was so good to us during the pandemic, and the logistics and all the stuff we had to worry about supply chain during that period. So we appreciate getting some of Gene's time. So Gene, I know we're back to normal. I know you guys in the Port of Los Angeles settled your labor issues last year. Talk to us about global trade. What's it like on a day at the Port of Los Angeles these days? How's business?
Paul, Emily, good morning. Business is really good. We're running at about 75 to 80% of full capacity at the Port of Los Angeles. Anything but normal, though, around the world, with issues in the Panama Canal with respect to drought, in the Middle East with concerns around safety and security, and broader looks at how this U.S. economy is going to continue to propel itself thanks to the American consumer. So let's start off with where we're at right now. 6 consecutive months of growth, the second best January ever, up 18% compared to last year, and our first quarter outlook is at about 2.2 million containers, or a 20% year-on-year increase compared to Q1 of last year.
So how would you assess then the overall health of the global supply chain relative to what we saw during the pandemic? Because like Paul said, it seemed like everyone was suddenly talking about the supply chain. And where are we relative to just a few years ago?
Emily, I think we're in a lot better shape. We've learned a lot from what we saw then too, but we're front of mind now to so many people outside our general industry. Whether it's us looking for our packages, what's on the store shelves, or just the general consciousness about how this port, supply chain, and trade business impacts economies and jobs around the world. What we see in Los Angeles is that there are a couple things happening right now. The stability of that labor contract has given us about a 4 percentage point boost in market share. So some of that cargo that we lost during the protracted negotiations has started to come back. Not all of it, much more work to do, but good trajectory. Now, with the Panama Canal suffering drought and the concerns of safety in the Middle East with respect to the Houthi going after the ships and the cargo and oil tankers, you're starting to see more cargo shifted our way. Not services being collapsed, not new vessels coming in, but higher levels of capacity and utilization, and importers and exporters saying, I may not want to take that much time, but the bigger difference is the gap between cargo that's moving east and Gulf Coast versus the West Coast is wider from a freight cost perspective. That's important because we're right now in the middle of our annual contracting season for freight.
All right, so you're, again, right in the port of Los Angeles on the West Coast. You probably have the best view of anybody trade with China. What's it like now? What's your expectation for that important route of trade coming from China to your port?
Paul, it's still our most dominant trading partner. 53% of Port of Los Angeles business is with China. Now, that's down from 57% at the end of year 2022, and it may drop into the mid-40s as many supply chain executives are continuing with their China plus one strategy, looking at other locations to source and produce goods in. But still, 45, 50 years of supply chain relationships exist. You don't tear that apart overnight.
Just the other day, the White House said that they were concerned that more than 200 ship-to-shore cranes at U.S. ports are manufactured by China and can be serviced and programmed remotely, creating a cybersecurity vulnerability. What did you make of those comments? How legitimate are the White House's concerns?
Oh, it's also very important to us. The Port of Los Angeles, Emily, was the first in the nation to create a cybersecurity operations center back in 2014 with the help of the Department of Homeland Security. Today, that system is stopping more than 60 million cyber intrusion attempts per month. It also gave us awareness to create a cyber resilience center, also one of the first in the world to bring in the private sector partners with us. That co-helped with the IBM folks, it has now stopped a half a dozen cyber intrusion attempts to private sector interests that they were otherwise unaware of. So this work must continue.
Give us that update. You mentioned the Panama Canal. I'm fascinated by the Panama Canal. I read a great book on it. I'll find the author later. It's phenomenal how they built that thing. So what's wrong with the Panama Canal? There's a drought, and so the water levels are lower, so they're not taking the amount of freight they typically take?
That's exactly it. And you think about a vessel at full capacity, they can't load to the top. And the transits through the canal are down some 23%, according to published reports thus far this year. Now, the Port Authority folks switched on. They're railing cargo from the Pacific side to the Atlantic for onward carriage to Europe and North America, but it's just not enough. And that's why this capacity issue is so important.
The Path Between the Seas, David McCullough. That's the book. Phenomenal about the history of the Panama Canal.
Some weekend reading.
It's some weekend. It's more than a weekend. It's a beast. All right. So, Gene. So, is your business? I mean, it's a GDP business. Is that how you kind of plan it out here? And so, do you get a sense of? Are your customers? Are they telling you? What are they telling you about their sense of the economy?
Broadly speaking, most are upbeat. 70% of our GDP is tied to you and me buying goods. Yep. Now, although the consumer purchasing was down a little bit in January, it was not unexpected. Great sales for the holiday season, nearly $1 trillion, up 3.8%. Last year, there was going to be a little bit of a lull in January, but the forward look is strong. The Atlanta Fed is currently estimating first quarter GDP around 2.9%, healthier than some had expected, and fourth quarter GDP came in beyond expectations. Again, what we see in the forward look is an order cycle that runs about 6 months ahead of when we actually buy things in the store or online. That inventory flow as a leading economic indicator appears good.
So, Gene, I'm the captain of this big monster ship. I got my containers all over the place. How they don't fall off, I have no idea. I come into your port. How long am I there before I get back on my way?
I look at these vital statistics, as I call them, Paul, every morning, and we're at or better than when we were pre-COVID. The largest ships that come into the Port of Los Angeles average 12,000 containers on and off, best in the industry every call. 4.5 days is the amount of time a ship is in port working. That's right where it should be.
All right. See, I think those things.